Okay, I think let's get started. We're a Swiss community, so we want to be on time. Welcome everyone to the third Token Engineering Switzerland event. For those of you who have not attended the first event, so Token Engineering Switzerland is sort of the low tax chapter of the global token engineering movement, which, as you know, is a movement centered around the professional engineering discipline that's emerging around cryptoeconomic systems. So we in Switzerland, our mission is really to bring stakeholders here together around that topic. And we're very excited that for this event, we're collaborating with the Crypto Valley Association, which many of you might know. It's kind of the biggest association in Switzerland, government supported, in charge of growing this massive blockchain ecosystem in our small country here. So we're very excited that we're collaborating with them. There's a panel at the end that they're contributing, and we hope that going forward, we can really deepen that collaboration, because it really brings the topic of token engineering to a whole new sort of set of stakeholders. There's a couple of housekeeping items that I've gotten from Angela, who leads the global chapter, or the global movement of token engineering. And I'm just going to go through this very quickly. We're going to send you a couple of links so just that you know what's going on in this community, because there's a lot going on. But I just want to go through them quickly. So there's a lot of progress on the CAD side. As you know, CAD is the leading simulation tool in the blockchain space, and it's open source. There's a vibrant community around it, and there's lots of news there. So if you go to cadcad.org, you join the community. There's lots of new models. There's lots of discussion that become more and more relevant to really very, very central topics in this blockchain space. The second thing is token engineering has an academy now. So earlier this year, Angela also launched the Token Engineering Academy. So if you want to head to, actually, what's the website? If Angela, if you're here and you could write the website in the chat, it would be awesome. But basically, you can go there and you can get structured education when it comes to token engineering. The first course is about network flow analysis, and it has received really quite excellent reviews. So if you want to check that out, do that. We're going to send the link around. Another thing is there is the TE Commons, the Token Engineering Commons, finally launched. It kind of feels it was in the making for like 23 years, but it's now live. And so basically it's a DAO that has the purpose of bringing the token engineering community to the next level. So there's funding and there's lots of stuff going on. So you might want to Google Token Engineering Commons. Then, very important, there is a Gitcoin grant going at the moment. So I think it's tomorrow or the day after. So you can support the token engineering community. If you like these free events that we're doing, or if you like to support the purpose of this community, then head over to Gitcoin. I also don't know the website for that, but like head over there and make a donation. You can actually, for those of you who don't know Gitcoin, you can multiply your money basically, because they do this quadratic voting. And so I think the only place where you can multiply your money in this way is if you put it in some DeFi shitcoin. But if you give it to Gitcoin, it really like helps an important purpose. So yeah, please do that. Then let's move to the event. So we have an evening packed with content for you. As you know, like we try and center our events around the cryptoeconomic design of these protocols. So we always have, the core is always design-oriented talks, and then we try and contextualize them. So basically you guys walk away with a sophisticated understanding, and also us actually, it's a learning opportunity for us as well, with a sophisticated understanding of a specific topic area. And we've chosen stablecoins because if you follow this space, there's just lots of news, like from governments, from regulators, from projects, and we just thought it's a timely way, it's a timely occasion to bring the community together around that topic. And we have a couple of really very cutting edge projects today. There's also projects that have gathered a lot of experience. So we have some empirical data to talk about and some very new protocols as well. So I hope you enjoy that. Then very practically a Q&A. So we hope that we have enough time for Q&A. We would like to ask the speakers to really be on time, do it the Swiss way, because we have to move through this, because at the end we're going to have a panel and some of the panelists cannot do it later. So we really have to move on as scheduled. But if there's time for Q&A, then how this works is you can write your questions into the chat, And then the moderator, Moritz, he will read them out to the speakers and panelists. And then lastly, so we've built a team of 4 people at Token Engineering Switzerland. Moritz and I, we launched this. We were the lone warriors like the first half of the year. And then Florian, who's moderating the panel, joined. And then also Markus Dapp, which I'm excited about, not only because of his last name, is also joining the team. And he's going to give a summary of the event at the end of the event. So first of all, please stay at the end of the event because you're going to get like the whole event kind of summarized. And second of all, if you wanted to organize these events with us, if you would be excited by moderating an event like this, a panel like this, just getting in touch with all of these awesome speakers, then get in touch with us. We want to like scale this up. I think there's lots more, there's so much stuff going on. We just need more hands on the ship. And with that, I hope you're going to have a fantastic evening. I'm going to hand over to Moritz, who's going to moderate the event. And I hope we all learn a lot today.
Thanks, Jonathan. Yeah, so my name is Moritz. I'm moderating now the first part of today's conference. We have 6 great talks. Each of them will be followed, as mentioned, by a short Q&A session. And I would really like to encourage you to type in your questions in the chat so that we can pick some of them depending on the time that we have left. And also at this point, I would like to remind the speakers to stay within their time. So because we have a great lineup, and I think everyone deserves and to have enough time to talk as planned. Yeah, but now back to the topic. Actually, today we are talking about stablecoins. It's something that used, in my opinion, rather far away, like 12 months ago. But last week, Brian Brooks, he's part of the US Ministry of Finance, acknowledged, and I'm citing here, national banks and federal savings associations currently engage in stablecoin related activities involving billions of dollars each day. As I said, it's a direct citation. And as a consequence, the department published now a letter saying that national banks may hold reserves on behalf of customers who issue stablecoins. In my opinion, this is quite a regulatory advancement and shows the popularity of stablecoins. But what are the actual implications of such an increasing popularity? Here, I'm sure our first speaker knows more. It's Professor Berentsen. He is Professor of Economics at the University of Basel, with a research focus on specifically on crypto assets and the monetary policy instruments such as negative interest rates and balance sheet extensions. So quite a current topic these times, I would say. He's a research fellow at the Federal Reserve Bank of St. Louis and a technical advisor of the Bank for International Settlement in Basel, and also co-author of the book Bitcoin, Blockchain and Crypto Assets that is published by MIT Press. As an economist by profession, I'm really excited to welcome Professor Berentsen for the first presentation of our conference.
Thanks a lot for the invitation. It's a pleasure to be here. You know, here I'm kind of the oldest, I guess, but when I attend meetings, say at central banks or the BIS, I'm probably the youngest. Okay, here let's start with my presentation. So the macroeconomic implications of stablecoins, and I would like to start with a very provocative slide. This is Augustin Karsten. He's the chief of the BIS, the Bank for International Settlement, and he published. No, he didn't publish. He gave basically an interview to the local newspaper here in Basel. And he said a couple of things like 2 years ago. This was like 2 years ago. He said, like, stop trying to create money. By the way, those that don't know the BIS is considered to be the central bank of central banks. It's actually a very important networking point. So all central banks worldwide come to Basel a couple of times a year to meet and to network. Then there are very important commissions at the BIS that talk about stability and how to coordinate monetary policy, but also how to coordinate the regulation of the financial system. This is all happening here in Basel, and he's heading this the BIS. Okay, what else did he say here? those crazy kids and their Bitcoin, when will they ever learn? And then he said something, this is really a quote, young people should use their many talents and skills for innovation, not reinventing money. Okay, I'm coming back to this. Now, here I have another quote from the BIS. The BIS actually is very active. They have written a couple of papers also on stablecoins. They are actually pretty good, so I can recommend them. They are not very friendly sometimes to, in particular to crypto. And this is one of the critique is the key issue with cryptocurrencies is there's unstable value. And I think as even if you are young, we should sometimes acknowledge if there is a problem, and I think there is a problem. I show you this here in this slide. This is from a Bitcoin maxi. You probably know him. He's called Bull, and he has actually a very nice website where he has a lot of graphs about Bitcoin, and this is just about the volatility. If you look at the red curve, what you see is basically the volatility, Bitcoin, US dollar volatility. The blue one would be a US dollar euro volatility. So a better graph actually would have been, you define a basket of goods, and then you look at the volatility between Bitcoin and that particular basket of goods, and you look at the volatility of US dollar to that particular basket of goods. That would be the correct comparison, but it looks the same. It basically looks the same. I think there's nothing to deny that Bitcoin and many other cryptocurrencies have just this enormous volatility. Okay, this is going back to this quote by the BIS. So this basically, this unstable value, this arises from the absence of a central issuer with a mandate to guarantee the currency's stability. Basically, they say is the absence of centralization that is responsible for this volatility. That's what they say. And let's look at this. Because there's a small other issue. Now, this is a typical example of centralized currencies, what you see here. Now, this is coming from my part. This is not, the BIS is not talking about, a lot about this thing here, this phenomenon, but what you see here are three currencies. It's the Argentinian peso. This is the Argentine peso, the black line, the Turkish lira, and the Mexican peso. And what you see here, this is across 50 years, from 1960. And basically what this graph tells you is the real value of money. So what you can buy with 1 unit of money, we have normalized it here to 1 in 1960. And basically the idea is that in 1960, with 1 peso, you could buy 1 unit of a basket of goods, right? And now you could see how rapidly these currencies devalue. If you take, for example, the Argentine peso, here you could buy 1 unit of the basket, 10 years later, a little bit more than 0.1. By the way, it looks very good because we put in the log scale here. If you don't put in the log scale, it will make like boom, and the value is gone of these currencies. And another thing that I really think is important to understand is this word, the word typical. It's typical. I mean, you can't find any, almost not. I mean, probably you find 1 or 2 developing countries' currencies where it doesn't look like this. Yeah, it's just standard. I give you some other countries now. This is the British pound, US dollar, Swiss franc, Japanese yen. Here you also, this is also log scale, but you see it's not as dramatic. So if you go from here to here, it's just a 50% loss in the purchasing power of these currencies. As always, the Swiss are the best, right? You know, this is Switzerland here. It only lost about roughly 70% of its value in 50 years. The British pound lost 95% of its value in 50 years. Now, 2 things that are interesting here. The first thing is that you have this kind of stretch here where it's pretty stable, in particular also for the Japanese yen. for almost like 30 years now, they have a stable value, the currency. And this is really this episode, you know, which actually central bankers don't like, you know, when you have even deflation or something like this, which basically the value of money goes up instead of going down. Switzerland had this very small, short spells of deflation here. So that's why we had a stable currency for about 10 years now. Good. One other thing that I have to say, it sometimes looks more dramatic than it is. So for Switzerland, if, for example, because this is, you know, like 50 years. So if you have inflation between 1.5% and 2%, that's how your graph is going to look like. And 2% inflation, so if the, you know, the real value of your money decreases by 2% per year, that's not really dramatic. I mean, you can live with it. But nevertheless, you know, over 50 years, you have a massive loss in value in these currencies. Okay, I give you a short summary of the history of government-issued monies. In my view, it's a history, you know, it's a history of failures, disasters, catastrophe, you name it. There are very few exceptions where it's not the case. I would say the Swiss franc is pretty solid, the US dollar is pretty solid, relatively solid, I would say. But just look at some recent examples. Look at Turkey, Venezuela, Argentina, Lebanon is a catastrophe right now for people. People are just, you know, their savings are gone. Okay, so I think, so I told you this, you probably knew that already, I don't know, but I'm certainly not the first one to observe this. What's the problem? I think the problem is centralization. You know, the key issues, this is the quote, this is not the BIS now, this quote is from me. The key issue with government-issued fiat monies is their unstable long-term value. It's not their unstable short-term value. They have no problem with that, but their long-term value. And I think this arises because central banks are central points of failure. They're basically honeypots. And I try to explain what I mean by being a honeypot. This is a typical balance sheet of a central bank, right? As a liability, you have money, the money they produce, and then maybe some equity here. And then they basically what they do with that, like these liabilities, they basically acquire assets. Typically treasuries, forex exchange, and you know, other assets. Nowadays, the Swiss National Bank, I think is the biggest Apple owner. So they have started to buy stocks and stuff like this. That's just recent, 10 years ago, they started doing this. Then quite often you have also gold, but you know, it's not so much about what they buy, but you know, this is really a honeypot. You know, there is hundreds of millions. I think the balance sheet of the Swiss National Bank is now more than 100%. I recently read it's 150% of GDP, Swiss GDP. That's huge. That's, you know, and politicians quite often, not in Switzerland, hopefully, but in many countries, they see these assets. They think, oh, that's fantastic. I want to get these assets. They attack the central bank. You know exactly where the central bank is. It's attackable. You can take these assets away. And that's what, for example, happened in Argentina. They just took these assets and put it in some pension fund that was failing. You know, no wonder that the Argentine peso is crumbling like that. And then there's another issue. Another issue is that politicians really love stimulus, in particular if the stimulus is targeted towards the election. You know, optimally 1 month, 2 months before the election, you hand out checks to the public so that you get their votes. And this happens regularly. I mean, Trump, you can be sure the next stimulus check is coming. It's straight 1 month before the election. You can be sure that this is going to happen. Good. Okay, I'm not the first one that has discovered this. The monetary history books are full of it. Monetary theory books are full of it. Satoshi Nakamoto has observed that, right? So, by the way, I would say Satoshi Nakamoto is Carsten's first kid, or one of the first kids of Carsten. Now, what did Satoshi? He saw all these things, and he said, okay, you know, we need to do this different. We need something, a censorship-resistant currency, you know. And the censorship-resistant currency requires a database that is immutable. That's why he invented the Bitcoin blockchain. Then he also invented this idea of permissionless, right? Everybody can participate in, you know, all the different roles. There is no entry control, no exit control, nothing like this. And on top of it, from a monetary policy or monetary theory point of view, the one important innovation was this kind of predetermined path for Bitcoin supply, right? It's written in the code. You cannot mess around it. It would be technically feasible to change it, right? If there is coordination among all Bitcoin users, but this will be very hard. I don't think this will ever happen. Good. Now, by the way, I'm a big fan of Bitcoin. I think it's fantastic. It's probably the biggest innovation in monetary theory or monetary economics the last 50 years. But we also need to address some issues. And I think some of the issues, so the idea was, Satoshi, this is from the white paper, right? You have this kind of censorship-resistant peer-to-peer versions of electronic cash, but somehow that object is not usable as cash. I mean, there are many reasons, but I think one of the main reasons is the price volatility. Nobody wants to pay, you know, 5 francs or Bitcoin for a coffee, and next day 3 Bitcoin units, and, you know, then 7 again. And so, I mean, the volatility is so enormous that nobody uses it as a payment instrument. There are other issues, scalability, then electricity use. I don't want to talk about these things, but you can read that in this book. So I have a picture. Moritz announced already the book. I think what is nice about this book, it combines monetary theory, monetary economics, you know, everything that we know from central banking and so on, with the technology, the crypto asset technology, Bitcoin, blockchain, and so on. And I think in that sense, it is unique. Okay, so now the issue for me is, can stablecoin, by the way, I found this interesting, Moritz, in the interview, you said, oh, they playing around with stablecoins and stuff like this. I mean, we have stablecoin. The Swiss franc is pretty stable. You can use it in electronic fashion. Of course, there is no blockchain, but who cares? We have the US dollar. That thing is pretty stable. I think the long-term stability is an issue, but short-term, you know, the coffee costs $5 today. It is going to cost $5 tomorrow. So there's no short-term volatility in these objects. So we have stable coins. So that's why I think in terms of innovation, it's not sufficient to have, you know, a stable coin in the short run, but what an innovation would be if we get something that is stable in the short run and the long run. I think that would be that would be the innovation here. Before we go to this path further, we need to understand where is the volatility coming of Bitcoin, and by the way, other crypto assets. Ether is you know. Most crypto assets are very volatile. I think there are 2 origins of the instability. First of all, it's a particular type of an asset that has no anchor. I will come back to this. Has no price anchor. And it also has no stability mechanism. There's nothing inherent in Bitcoin that stabilizes its price. And by the way, I want to say this is also important. I think this is by purpose. It's not that Bitcoin fucked up. They didn't want any stability mechanism. And the reason is every stability mechanism introduces some degree of centralization. I mean, there's no question about this. You certainly, because the blockchain itself doesn't know the dollar price. The blockchain has no fucking idea about what's the value of an Ether or something like this. So at least you need to feed in some through oracles prices and stuff like this. So that's already moving into some form of centralization, right? And I think Bitcoin by purpose said we don't want that. Good. Okay. Now I'm going to make some Bitcoin Max is really angry. Bitcoin has no intrinsic value. You know, it's basically intrinsically worthless. What does it mean? It cannot be consumed. It's not commodity money like cigarettes or some other commodity monies where which you can consume. You can't use it in production like gold and other monies. It doesn't pay any dividend, doesn't pay any interest rate. It's basically an intrinsically worthless asset. it has absolutely no anchor for its price. So, okay, don't hate me, Bitcoin maxis. Every textbook, all research that I know in monetary theory says that's exactly what you want, you know. And you want an intrinsically worthless medium of exchange because this is welfare maximizing. It's the best asset in terms of welfare. Okay, now Bitcoin maxis, please accept this because they have all these weirdo ideas, you know, why Bitcoin has some intrinsic value. Anyhow, let's move on. Now we get to price discovery. I said there is absolutely no anchor, yeah, for the price of Bitcoin because it has no intrinsic value. Then price discovery for any intrinsically worthless asset is 100% forward-looking. What do I mean with it? You know, the price that I'm willing to pay today for a Bitcoin only depends on my expectations, what I think that object is going to be worth in the future. It's totally forward-looking, right? And these price expectations are just shifting around very quickly and sometimes really dramatically, massively will be a shift in these expectations. Suppose some regulator comes in, says something, or Trump comes in and says Bitcoin is bad, then this has immediate, you know, you see an immediate reaction of the Bitcoin price. And the result of is that, you know, this type of assets have by nature high price volatility. Now the second thing, it's not enough. That's not enough, right? These assets by nature have high price volatility, but you actually can tame them. But Bitcoin doesn't want to tame them. You know, what Bitcoin, when you look at this little graph, this is demand, supply, and the equilibrium price of Bitcoin. This is a static model, of course, but this is also true if you do it more dynamic. It looks very similar, a bit more complicated, but the basics is here. What you see here is the Bitcoin supply. It's a vertical line. At any point of time, the amount of Bitcoin given, and it's given by the protocol. Nobody can mess around with it. It's kind of moving, you know, a little bit to the right and until it's stuck at 21 million, but that's it. And then you have this falling demand curve for Bitcoin. And as I said, because the demand for Bitcoin depends on these expectations. You know, what is the future value of Bitcoin? That's why the demand function is kind of shifting around like mad day by day. And that's why you have this massive price effects, right? Good, let's move on. So government, by the way, government issued fiat money is also intrinsically worthless. You cannot do anything with the dollar. You cannot clean your ass, you know? Well, you can take a banknote, but otherwise it's completely useless. You can't eat it, you cannot feed it to your cows, you cannot do anything with it. So it cannot be consumed, cannot be used in production, pays no dividend, no interest. So it's also fiat, right? It's intrinsically worthless. But nevertheless, we just saw, well, these guys, somehow the US dollar is pretty stable, right? The Swiss franc too. And now this has, you know, the reason is they have a stability mechanism. Bitcoin has no stability mechanism. So what is the stability mechanism? The stability mechanism, again, is based on the balance sheet. We looked already at this balance sheet, so I'm not going to explain it again. At the end of the day, what central banks do, and that's called open market operations, or even QE, they basically, for example, they produce more money and buy assets. This is a balance sheet extension. Or they go the other way around, they sell assets and buy the currency back. So they shrink the amount of currency in the system. But in order to do this, you need a balance sheet. Elastically adjust the money supply, you need a balance sheet. And Bitcoin can't do that, but Bitcoin has no balance sheet. Because Bitcoin is no liability. It just came somehow in existence and now it's there, but there is no balance sheet. You cannot adjust the money supply by selling Bitcoin or buying them back because there is no balance sheet. You can't do it. And Bitcoin inventors didn't want to do that. So this is by purpose. Now, but you also see now why government issued currencies are so stable in price. Certainly in the long run, in the short run, the supply curve is totally horizontal, right? And this is in contrast to Bitcoin, it's vertical. And now what you see when the demand for the US dollar shifts around, and it also shifts around quite dramatically. So what is these shifts are absorbed by the balance sheet of the central bank. And that's how they can keep the dollar stable in the short run. For some reason, they don't want to keep it stable in the long run, because for some reason central bankers think 2% inflation is a good thing. I have never understood this. And there is absolutely no proof in any scientific paper that I know that 2% is good, but nevertheless, central bankers think 2% inflation is a good thing. They could have a goal of 0%, then we would have stable monies, at least for the euro or the Swiss franc or the big ones, right? Good. So so how do I do in time? Because I have no watch here.
We are perfectly in time, so we have 13 minutes left. Maybe we can like have or reserve 5 to 10 minutes for a Q&A.
Okay, can I do more 5 minutes more, or is it finished now?
Yes, that's totally
5
fine.
minutes. Good. I think this is this is really an interesting trade-off that I kind of think is at the heart of the discussion. So Bitcoin, short-term price stability requires some discretion over the money supply. So discretion of the money supply really means that the central bank can determine the money supply, right? So the short-term price stability requires some form of discretion over the money supply. You must be able to manipulate the money supply in order, if you want to attain this goal. I think the long-term price stability, actually, you really want to have rules. You want to take this away from the central banker, right? And it seems to me there is a trade-off here. You know, Bitcoin uses 2 at the cost of 1. He said, I really want this. The code is the rule. The code tells me what is the money supply in 10, 20 years. But because they want 2, they cannot have 1, right? That's why you have the price volatility in the short term. And I think government fiat money, central banks choose 1 over 2. They say, no, I want to have discretion over the money supply, but this also means in the long run, I cannot commit to a certain path for the money supply. And I think if you want to solve that, if you want to have 1 and 2, the issue is, can stable coins provide us with both? You know, have this kind of short-term manipulation of money supplies, and at the same time having a long-term goal that cannot be questioned, cannot be attacked. This, I think, is the issue here. I make a small introduction in stablecoins very quickly, because I want just to show one thing that I think is important to me. At the end of the day, what is a stablecoin? It's just a cryptocurrency that is developed with the aim of minimizing price volatility. I go quite quick here, you know them, Tether, USDC, DAI, and so on. The first one emerged in 2014. But what I think is important is this graph here. I think at the end of the day, if you design a stablecoin, you need to think about your stability mechanism very carefully, about the economics of your stability mechanism. How do you guarantee that the incentives in the system are such that that thing really remains stable? And you have to think about collateral. I think the easiest way to get a stable coin is by having collateral. Good. Now there are, one stability mechanism is algorithmic. There are these kind of, I'm not a big fan of it. People that think, we just need some fancy algorithm and, somehow this sorts that thing out and then this thing is going to be stable. It's a bit voodoo economics quite often. I think that Basis tried this, but then they gave up. They say because of regulation. I believe they got some economists that told them this is not going to work. This completely differently here. I think some people are here that try to work with these algorithmic stablecoins. We will see. Now there are these other stable coins that use collateral. That's basically the stability mechanism. It's just there is collateral that backs them up. That's like a central bank, right? They in fact have something almost equivalent to a balance sheet. And then, of course, the collateral can be on-chain with DAI. It can be off-chain like Tether. I really don't like Tether that much because that's the, I mean, we already have banks. Why do we need Tether? I mean, I just don't see this. They are just like a bank. This is a central point of attack, you know, central point of failure. You know, everybody can shut down Tether, every regulator at any point of time, and that thing is gone. I kind of like DAI or, you know, stable coins that have collateral, and but it's backed up by online collateral, on-chain collateral. Good. That's it. So I think I stop here. That's my thing. This is for, I know I need to be provocative. I will see what some people say here. This is for algorithmic stable coins. I'm really tricky about it. Good. I'm more or less done. Thanks for listening. So this is just my comments on this, and just look at my book again and of course buy it. Should I stop the sharing or how does it work now?
You can if you want. So first of all, thank you for this quite interesting presentation. I really like the comparison of Bitcoin and fiat currencies regarding the value stability, and that actually there's a sort of a trade-off in the short term versus then the long-term commitment. I have a question. As far we have no questions from the audience, I have a question regarding on the first slide where you showed the value loss of money. And I was wondering against what are you actually measuring that?
This is the idea. So what central banks do, that's how the price level is determined. They basically define a basket of goods, right? They basically try to figure out what is the average household consuming and so on. They put these goods in this basket. And then they basically, when they measure the price level, they say, how much money do I need to pay in order to buy 1 unit of that basket of goods? And the inflation would be, you need to pay more money over time to get the same basket of goods. Deflation would be just the opposite, right? It would mean you have to pay less money over time to acquire this basket of goods. And what I actually showed you, the graph is just, it's called the real value of money. It's just the inverse of the price level. I wanted the graph to go down and not up, because some people think if the graph goes up, it's good. If it goes down, it's bad. This is not always true, right? But here in this case, it's bad. If it goes down, it means you can buy less and less with the money over time. It's the same, you know, 1 franc buys you less and less and less over time.
Okay, so it's measured against currencies.
Yes.
Basket of currencies.
Yes.
Okay. Okay, so now we have a question from the audience. Professor Berentsen, are CBDC and stablecoins complements or substitutes?
It really matters how the CBDCs are designed. There are 2 types of, two ways to design it, I would say. You could, you know, there's one, that's what I propose. I say, if people can hold accounts at the central bank, we have already CBDC. This could have done like, you know, we could have done this 20 years ago. You just open an account at the central bank, you have a balance, you have some deposits there, and you can use these deposits to make payments. And basically you have central bank digital money. But then there are these other people that think, oh, because they have heard about Bitcoin, and now they think, then they came up with this idea of Fed coin. Oh, the Fed should issue a digital currency. Then I always say, why would the Fed, you know, a central bank, why would the central bank issue a decentralized currency? It will never happen. So they will do some, but they could, of course, start a completely new network. Right, and where the Swiss franc, the digital Swiss franc or the digital dollar has some properties like a token, so this is possible. And the third thing what they could do, technically, it would be very easy, you know, just issue a ERC20 token and run it on Ethereum. And of course, you have to be ready to buy and sell it to keep its price stable. But again, they will never do it. And I would also propose, I would not consult them to do this because I mean, Ethereum, I really love it, but that's such a young technology and you don't want to rely on this. We don't know where this is going. And you know, the volumes that it has to support, the Ethereum blockchain is just not ready for it. And none of them is. So I believe, I was actually relatively pessimistic about stablecoin for a while because I knew that CBDC will come for sure. And then there's for the average Joe, there's absolutely no use. Why should I hold a tether if I can hold, you know, if I can hold a Swiss franc or a US dollar, a digital US dollar issued by the Federal Reserve? I think, but there still have some roles because I think the cryptocurrency networks are quite separated right now from the rest of the network. So if you want to have some value that is stable, say on Ethereum, then that's the way to go. That's why Tether is used so much because people want to go in and out of cryptocurrencies. That's why it's used basically. I don't think it's used for payments.
Oh, great. I think this also answers my questions that I had. So what is the actual value of the current stable coins that we have? So yeah, thanks a lot. Is Gustav already here?
Yeah, I'm here.
Great. So yeah, now let's say from more like from this macroeconomic perspective to the actual design of stable coins. And here, first in our line of speakers, we have Gustav Arentoft from the Maker Foundation. He's responsible for business development in Europe for the Maker Foundation. And it's quite interesting because Maker is one of the front runner for a decentralized crypto-collateralized stablecoin. And it's really great to have him on board. So please, Gustav, take it from here.
Yeah, thank you so much, Moritz. I'm just gonna share my screen here to pull up the presentation. Cool, and thanks so much for a great presentation, Aleksander. I definitely think there was a lot of really good topics that you touched upon. I'm happy that you named DAI as one of the few designs that you were actually, you know, positive about. Cool. So now I'm gonna go a little bit further into what the system behind DAI is, some of the stabilizing mechanisms we have here, and kind of like what you know gives DAI its intrinsic value. So first off, my name is Gustav, and I'm currently responsible for the business development in Europe. I also do a lot of our projects in Africa. Have previously done a lot of our projects in Asia as well. So I spent 3.5 months in Asia last year setting up a lot of our business departments out there. Before I joined Maker, I was living and working in Argentina, doing consulting within financial technology. I got paid in pesos, which, you know, as you probably also saw in Aleksander's presentation, wasn't the most fun thing in the world. So kind of like when I had the opportunity to join Maker, this was really, you know, like a no-brainer for me. You know, I feel that that like what stablecoins really can offer to the developing countries is an access to a global financial system, right? Something that we are seeing in a scale and in a matter that really hasn't been seen before. So DAI is from what we see, it is the world's first unbiased currency. When we mean currency, we don't necessarily see Bitcoin as a currency in that sense. Bitcoin is used for a lot of things, but is simply not suitable to be, you know, a medium of exchange. It can be a store of value if the conditions are right, and then it also fails at being a unit of account. It's simply very, very difficult to price things in Bitcoin unless they're like very, very expensive already. So in comes DAI, and kind of like the standpoint where DAI was created from. So the foundation was founded back in 2015. So it also actually predates Ethereum. But where DAI really was created from was that you know we wanted to keep all the inherent properties of what Bitcoin was and what it set out to solve, but we wanted to add stability to it. So DAI is a stable, decentralized currency, and it does not discriminate any individual or business from all over the world. and anyone can realize the advantages of digital money. We have, people using DAI in, globally in over 150 countries from what we know of, and we also have a long list of partners. I'll go a little bit further into that a little bit later. So DAI was really, spawned from this idea that like to reach mainstream adoption of any cryptocurrency, you need to really have a stability, right? So if you keep on having very volatile assets, it makes it very unsuitable for everyday transactions and for the normal user. So that also means that, of course, a lot of things are happening with DAI in the Ethereum ecosystem, but we also have, regular people, the everyday Joe, who's using DAI as digital money. This is something that we see a lot in emerging economies. So, for example, one of our biggest markets is actually Argentina. We have a team present there as well. We're also seeing increased activity in places such as Southeast Asia, East Asia, and Africa. Where DAI comes from, like the properties that DAI has is that it has a target price of $1. It's a soft peg. So due to some stabilizing mechanisms, DAI aims at $1. However, with soft pegs that we also know from traditional currencies, of course this can fluctuate, but usually stays very close to the dollar. DAI, with an upgrade we had last year in November, is now backed by multiple asset types. So currently we have 13 different types of collateral backing DAI. This is mostly crypto collateral currently, but also includes some stable coins. And the exciting thing here is that the system is really built in this very open fashion. So over time, we're looking to onboard things such as, for example, real world collateral as well. DAI also has a built-in savings rate. So, this is quite similar to what you would see from like a deposit account at a bank. It's made a little bit differently though. It's currently 0 because we're having too much demand on DAI, and it's one of the monetary policies that the governance community can exercise to improve the stability of DAI. So basically, if we see DAI hovering slightly below the peg or around the peg with a solid collateral pool that can facilitate it, we're actually able to give a native interest rate on DAI. With the addition of these real world assets, Maker and DAI is all the foundation, and as well as the community is really looking to expand beyond crypto. We are already seeing a lot of interest from traditional companies, also financial institutions, SMEs, people working with different kinds of use cases such as invoice financing or trade finance, who are very interested in seeing how their assets could become part of the collateral pool backing DAI. This goes quite well into the next step, which is that we are completely open and transparent. You can at any given moment go in and take a look into what is backing DAI, what is the health status of the system, and this is something that is quite important because Aleksander also mentioned you can kind of like draw the reference to the MakerDAO protocol, drawing similarities to a central bank, and at the same time also operating a commercial lending book. The open transparency here is really needed, so you can always make sure that there's like sufficient collateral, there's like the right types of collateral, and this is done in a completely open transparent way. It's governed by what's called a DAO, a decentralized autonomous organization. So we have a forum where people go in and participate, and this really driven by the community. So over time, the foundation will also actually dissolve to make DAI and the MakerDAO protocol what would be seen as like a common good. With these external collateral types, we're also looking to really bring scalability to the decentralized finance sector. If we take DAI and we compare to some of the other stablecoins, I'm going to do this quite quickly. We see the centralized models with Tether USDC, TrueUSD, for example. These have a centralized issuer, both on the collateral ownership as well as the people actually issuing the stablecoin. You are quite dependent on the audits of their bank accounts, whereas DAI, both the collateral and the issuance is completely controlled by the users. We also see the algorithmic stablecoins that does this quite differently, which is Basic, Amplify, and Terra. The mechanisms there are seen as quite experimental, and it requires quite a deep understanding into the systems to actually see what does this actually mean. And so far, none of them has really gained significant traction. When we say DAI is asset-backed, it basically means that we have these smart contracts on the blockchain, on the Ethereum blockchain, where people can deposit in collateral, currently 13 different types. We have 25 more types in the pipeline. You lock up the collateral, and based on the value of the collateral, you can generate a certain amount of DAI. You can use, spend, or give the DAI. To retrieve your collateral again, you need to repay the DAI plus a fee. So that means that for every single DAI out there, there's an excess of collateral. This is maintained by what we call a liquidation mechanism in the system. So basically, if your collateral drops under a certain threshold, you will be liquidated. So your assets will be taken, sold in the open market, and a penalty will be applied. This is like a way of like making sure that you always have more collateral in the system than DAI in circulation. This is also one of the health factors that people are often looking at. If you look at like the complete system, we kind of like have a two-sided approach to DAI itself. We have the money supply, which comes from the collateral being deposited into the system where DAI is being minted. And then we have the demand side, which is where DAI is being used all over the world in a lot of different applications. And lately we have seen a lot of decentralized financial services being built using DAI. Here, I would state that I think one of the most important innovations that has been done in this space is really the ability to interact in these financial services online. We have never really been in an era before where you would be able to do financial transactions without having a centralized entity facilitating them. So currently we are seeing a lot of protocols, some of them more experimental than others, but basically allowing people to earn interest rates, get loans, and buy derivatives and do other types of financial transactions without centralized entities facilitating this. In the middle of this entire system and in this complete monetary system, we have the risk governance, which is being controlled or governed by our other token, which is called the Maker token. The Maker token's primary goal is to facilitate the stability of DAI. So here what they really look at is that they look at the different collateral types coming into the system. They set up different risk parameters around these collateral types. So what is the liquidation threshold? What is the stability fees? The risk premiums you have to pay for borrowing against these assets, borrowing DAI, and what is the stability of DAI currently? And balancing all of these things to ensure that people can kind of like count on the price of DAI and the ability of DAI. Some of the stuff that I'm working a lot on, working on the business development side is really the ecosystem and especially on the business front, right? So one of the things that we saw quite early with Maker is that we're really only as strong as the amount of projects and people that use DAI globally. So right now we have more than 900 partnerships globally, and a partnership for us is someone who actually we have DAI integrated into their protocol. You could also have integrated our borrowing services, so our smart contract system where people can generate DAI against assets. We also see quite a few of these integrations, but basically expanding the MakerDAO ecosystem to as many places as possible. We have also received investments from quite notable names like Andreessen Horowitz, Dragonfly Capital, and Paradigm. We were nominated and rewarded with being one of the tech pioneers of the world by the World Economic Forum, as well as being listed as one of the top 50 fintech companies in the world by Forbes. So we're really at a position right now where we have a very, very good standpoint of kind of like expanding outside of the crypto space and pushing DAI into what we hope would be more mainstream adoption. I'm sorry if I rushed through the presentation a little bit. I was only given 10 minutes, so we also had some time for questions. But if you are interested in hearing more about it, you should go and follow us on Twitter at MakerDAO. You can also follow me on Twitter. Feel free to send me an email if you're interested in learning more about DAI, or reach out to me on LinkedIn. Now we have around like 9-10 minutes left where I will be answering some questions.
Thanks, Gustav. Great presentation. So if you have questions, please let us know in the chat. So I was wondering, like beginning of the year, the price of Ethereum dropped like drastically, right? It was in March, and back then you had this single collateral basically only, and the DAI was struggling quite a lot because of the low price of Ether.
Mm-hmm.
And has sort of left some DAI worthless or under collateralized. And I was wondering, how did you solve this issue back then?
Yeah, so I mean, there was several things that caused this to happen, right? We also saw the Ethereum blockchain being clogged up at that moment. But basically, in the MakerDAO protocol, Maker acts as kind of like the insurance for the stability of DAI. So in the case where a collateral drops so quickly that we cannot liquidate it to get the same amount DAI back from the market as we have DAI dipped in the position, we basically, first off, we kind of like have a treasury where part of the fees goes to, and if the amount is bigger than this treasury, we will mint MKR and sell it in the open market. So that was basically what happened back then. That some of the DAI was left unbacked, and thereby we had to sell MKR for DAI to burn the DAI and thereby reach equilibrium again, right? So that was basically what happened back then. The system wasn't really built to be a single collateral system, and as it is with many of these systems, it's still early days. So things like that is not expected to happen, but we definitely have things in place if something like that happens.
And what are basically your learnings from that?
I mean, we're onboarding a lot of different collateral types now. We updated a lot of the auction mechanisms. We've increased our treasury as well. So we've been doing like a lot on the front to basically make sure that, like, in case that we have like quick collateral drops again, or potentially later on we will have like real world assets, for example, that we will be able to withstand that as well, right? And defaults on collateral types, like a collateral going from 100% to 0, is something that like the system takes into account. So it's expected to happen. So we have like measurements in place. I think one of the things that's like important to mention here is that when you deal with decentralized systems, you need to expect every single edge case to be able to happen, right? So these systems are built up on a lot of game theory, on how people will act, and especially like the individual access of the system, because since the system is decentralized, you basically have this like online community of people from all over the world who needs to be able to bring back stability, for example, or take part in different parts of the system to make sure that everything is at its balance. So we prepare for every single edge case. Of course, like if all of our collateral went to 0, we would have a big problem. But like most, like the edge cases are definitely accounted for.
Yeah. Regarding the stability, one question from the audience. So if the purchasing power of the US dollar inflates over time, meaning it loses purchasing power, actually, that should then also be the same for the DAI, isn't it?
Yeah, sure. I mean, we're pegged to the dollar, right? So I would also say here that like the way that you can look at DAI is that, like, since DAI is not one-to-one back with the dollar, we don't have any formal relationship with the dollar, right? The reason why the dollar peg was chosen was because it was like the most used currency in the world. But in the initial white paper, that was actually described the basket of goods and assets that would be the price of DAI. But an already complicated system would have been even more complicated, right? So basically, we're also looking later on to issue other synthetic assets, you can call them, with the different pegs. So over time, like the community is also looking to issue, like a euro peg DAI, for example. And of course, like if the dollar would like drop significantly in value, you could remove the peg from the dollar and peg it to something else. This would, of course, be like a quite difficult process, but like it's definitely possible to migrate the system in that way.
Right. Another question from the audience. How about the high transaction fees on Ethereum? So how can they be used in developing countries where the actual income of a person is rather low?
Yeah, so there's like 2 different ways to solve this, right? So to this day, we still see a lot of the activity happening on centralized platforms. So like a centralized platform actually doesn't need to do blockchain transactions when they do transfers. You know, exchanges is like a good example. There's a lot of wallets that does this way. This is not something that I'm personally like too big of a fan of, but you know, it's still like where we see a lot of the activity. I would say with you know, like the DeFi services booming over this summer, it really increased the gas prices on Ethereum, and it also proved that, you know, like the ability to have, you know, like a digital currency with a stable value, it, you know, can provide you with like incredible value online, purchasing this alternative financial system. The other way to do it is to use like a layer 2 scaling solution. Some of them, you know, also comes in with certain risks. Some of them, for example, have like a bigger degree of centralization. Some of them, you know, has like a pretty big onboarding cost because you need to set up a smart contract when you onboard into the layer 2. But basically right now, I think a lot of the projects we're looking to you know, figure out like how can we solve the scalability issue using, like, for example, like a layer 2 solution until ETH 2.0 comes out. On this front as well, you know, we are seeing a lot of development, of course, because of the high gas prices. So that is, for example, some of the ways that we're dealing with it. I'd like to give you a little bit of like an idea about the scale. We have we work with a platform in Argentina. They have around 70,000 weekly users of DAI. They do around $6.5 to $7 million in weekly or DAI in weekly volume. So like even with like the high gas prices, there's still like a significant market for it. And this is Argentina, where, I mean, people's salaries are quite low as well. I mean, of course, it's not Africa, but I think one of the bigger problems that we also see in for example, like the African countries is that it's very underserved currently, right? Which is also why we try to do more stuff there. But in general, when the infrastructure is bad and when the local scene is bad, so if there's not a lot of, you know, local companies that actually deals with, you know, like education or, you know, have like local applications, it's also very difficult for like the crypto companies from outside to target those markets, right? So that is like some of the stuff that we also spend a lot of time on building out.
Wow, awesome. Thanks a lot, Gustav. I can really like encourage you. I think there are still some questions left for you personally, also in the chat. Maybe you can join the discussion over there. In the meantime, for our next talk, we stay with the topic of stablecoin designs. Next up is Stefan Ionescu. He's the CEO of Reflexer Labs. He was previously a Binance X grantee and did some R&D on stablecoins and in insurance for DeFi protocols. Before Binance, he worked 2 years in the crypto space on tokenizing loans with Intel. And at Reflexer Labs, they are building a asset that's meant to follow the price movements of Ether in a more gradual way. But what does it mean exactly? He will show us himself. So Stefan, over to you.
Thanks, Moritz. Hey everyone, I'm Stefan from Reflexer, and today I'll give you a very brief overview.
You are still on mute? Yeah, perfect.
How about now? Do you hear me?
Go ahead, maybe then we will see if it works.
How about now? Sorry.
Perfect. So yeah, I think acoustic is fine. Just share your screen and then you can start.
Cool. So hi everyone, I'm Stefan from
And it would also be great if you could switch on your camera.
Let me try that. All right. Cool.
Perfect.
Cool. So today I'll give you a brief overview of what RAI is, our first asset that we plan to launch, meaning I'll talk about what it is, why we're building it, and when we plan to launch it. So the first thing to note is that RAI is not actually a stablecoin. We do not plan to peg it any specific value. Rather, RAI is an over-collateralized asset. It is backed only by Ether. It is managed by an on-chain PID controller, and it is meant to dampen the volatility of Ether, meaning that if Ether drastically moves its market price over a short period of time, RAI, the PID controller managing RAI, will try to incentivize market participants to also change the market price of RAI, but more gradually over a longer time frame. And we think this attribute can be really useful for other DeFi protocols if they want to use RAI as a collateral type. And we actually started with the idea of a new collateral type that can replace Ether in decentralized finance, because right now most of DeFi is backed by Ether. But the disadvantage is that many people who use Ether can quickly get liquidated and they can lose a lot of money. So we actually hope to give DeFi users a bit more time in case they use RAI in their positions to actually withdraw their collateral and save their money. And right now, we're actually doing a lot of research to build the PID controller that is managing RAI. We're actually splitting the work between ourselves. We are building the direct solidity simulations. We're building kind of a small framework to directly simulate the smart contracts that underpin RAI and the PID controller. And our friends from block science are actually helping us with cat models. And right now we're also in the process of actually synchronizing the two models. And one thing that we learned is that you need to take into account the time units that you use in your models, because in Solidity right now, we're actually using an annualized output from the PID controller, whereas in CAD we don't. And that's why you can see that the response in CAD on top left is way stronger compared to the Solidity one that is only annualized. In order to actually test RAI in production, we plan to have a very small demo in a couple of months from now on mainnet to actually see how people want to use an asset like this and what happens to the PID controller if we tune it in a specific way. We then plan to gather all the data from the mainnet demo, analyze that, and reintroduce all that data in our models to reevaluate them and possibly pick other parameters for the PID. And then a couple of months after that, we plan to actually release the big mainnet system and let people play with it and see exactly what happens. This is a very experimental system, and we plan to only gradually allow people to create more RAI and see how the market reacts. I don't really like long presentations, so I would rather actually get more questions from the audience. That's it for me.
Thanks a lot, Stefan. However, I would be curious. So, what do you make different compared to other stable coins? So, yeah. So basically, the question, in other words, is what is the stability mechanism behind that?
We actually took the original vision for DAI, in this case for RAI, because initially DAI was actually meant to be kind of an asset that is not pegged to a value, in this case $1. It was meant to fluctuate in price, and it was actually meant to have, in the case of DAI, you actually have a target price that is $1 in their case. But in the case of RAI, the target price is always moving. And that's actually the incentive that makes people create possibly more RAI or less RAI and pay back their RAI debt, because RAI is actually created against Ether, exactly like DAI. But that's the main difference. We actually have our target price is not one, it's always moving up or down depending on what the market does. And that's what the PID controller actually tries to do. It changes this target price in order to incentivize market participants to bring the market price back to the target.
So can you basically think of RAI as a moving average version of the underlying collateral?
In a way, yes. In a way, yeah. It actually, in the short term, RAI won't necessarily be a moving average. It will only react to what the market does. For example, if the market price, let's say the target price of RAI is $5 but the market price is $6. The PID controller will try to change the target price in a way that incentivizes people to generate more RAI, dump it on the market, and this way try to bring the market price back down to the target price.
Mm-hmm. So may I ask, assuming there is no pre-mining, what is the business model of Reflexer Labs?
It is very similar to the one actually in Maker, where we have a token that will be used to govern the system only in very small parts. Most of the system will actually be autonomous, but a few components such as the Oracle will still need to be managed by governance. And that's why we also have a system that actually has two tokens. One of them is RAI, and the other one is this protocol token used to manage all the components.
And you get a cut of trading these tokens?
We have a borrowing fee for every RAI that is generated by the system. That borrowing fee actually goes, most of it will go to incentivize people to update the on-chain PID controller and the Oracle, so that the system kind of becomes self-sustaining.
What are the biggest challenges you face along the way when working with these tools and doing some token engineering?
It is really hard. It's not, in a way, it's really hard to apply PID control theory to crypto because, for example, we have different time units. In crypto, you need, in our case at least, we recompute the rate every hour, whereas in normal PID controllers, you can even compute every millisecond. So it's, in crypto is a bit different. And right now we're actually learning about how we can apply normal PID control theory into smart contracts. So I think that's the biggest challenge.
Another question regarding the design of RAI is it actually fully collateralized?
It's actually over collateralized, exactly like other stablecoins, crypto collateralized stablecoins on Ethereum.
Okay. Can you say something about the degree of over collateralizing that you're modeling?
Right now we're using 150%, very similar to DAI again. But so we're using 150% for RAI.
And the borrowing fee, is it fixed or is it variable?
It is fixed. So in this case, it's fixed. We don't yet have a number for that. We're still thinking about it. But the thing that fluctuates into the system is the target price, but the actual borrowing rate will be fixed.
You mentioned in a CoinDesk article that 90+% of the system will be completely closed off and humans won't be able to change anything. How can you be sure that there is no need to adjust something along the way, like that happened with Maker?
Maybe there is.
DAI.
I mean, we'll actually have to have a demo on mainnet to see how the system reacts and decide which components will still have governance. But the vast majority of them actually don't need governance. We will need governance for things like the Oracle, because governance might need to upgrade the Oracle every once in a while. We might also need some governance for the PI controller and actually adjust all the parameters in it. But apart from that, we don't really see any need for governance over the long term, at least.
Okay, so you're basically assuming that you can sort of model all the edge cases that might arise in the future already today. Is that right?
We cannot model everything. We hope to learn as much as possible from our mainnet demos and learn from the actual big system until we actually remove governance. So there's a risk that the system can blow up at some point in the future, but we hope to get to cover most of the edge cases until we remove control.
What in your perspective, what are the main use cases for RAI?
I see mainly two. One of them being a collateral in DeFi, maybe actually replacing Ether as a collateral in DeFi. And the second one for potentially onboarding investors in crypto. For example, many investors that I talk with here in London, especially institutional investors, don't really want the volatility that comes when you hold Ether or Bitcoin. And we are thinking about actually advertising RAI as a potential stepping stone from the normal financial space to crypto, where you first hold RAI, you get a taste of what it means to actually hold crypto, and then you can actually go and diversify into Ether or Bitcoin.
Can it also be used as a collateral in other protocols?
Apart from decentralized finance?
Yes.
You can use it as collateral for anything. Yeah, you can even use it for under collateralized protocols. Basically, if you need kind of a collateral type that's slightly less volatile than Ether, you can choose RAI.
Okay. So, can you give us like a bit of the current setting of your team? Like, how big are you, and how many people take care of the technical part?
Sure. Right now, we are 5 people full-time. We also have block science helping us on the simulation side. We plan to bring other 2 people in the near future, one of them who will be full-time on simulations and the other one also helping with smart contracts.
And if you're looking for someone like that could strengthen your team, what kind of know-how should this person contribute?
Ideally, they should already have experience in control theory. We like people who have a background in electrical engineering because they usually work a bit with PID. And ideally, they can translate kind of very technical specifications into Solidity code because we talked with many people who are actually very good with PID, but they're not really that practical. They cannot really translate their ideas into code.
I saw that you actually raised quite an amount regarding the regarding a seed financing route. So, congrats for that. What is your roadmap? Can you show us like what is the time to market and what are the biggest milestones until then? Thanks.
Sure. So in a couple of months from now, meaning ideally in January, we would like to have a very small mainnet demo where anyone can actually put Ether into the system and generate RAI and then try to actually break the system to see how people come up with different ideas to break it. Especially, we would especially like people to break the PID controller so that we can make it stronger. We would like to have the demo running for at least 1 or 2 months. After that, we would like to get all the data, gather all the data from the mainnet demo, analyze that, and see if we can come up with new ways to actually make the controller stronger, or at least, at least make it so that people cannot easily manipulate the controller. And 2 months after that, I would say maximum, ideally in June 2021, we would like to actually launch the big mainnet system.
Wow, super exciting to see more about a Reflexer and RAI. Thanks a lot for your talk, Stefan.
Thank you.
So now we come to the last talk of the series of stablecoin designs with Robert Lauko from Liquity. Robert and Liquity are actually a great example of the growing token engineering community in Switzerland. We actually met on our first event back in January here in Zurich. And regarding his background, Robert actually graduated with a PhD in law from the University of Zurich before he turned into a blockchain researcher at Dfinity in 2017. And after dedicating his time to consensus algorithms and other layers of the Dfinity protocol, he decided to work on stablecoin lending and founded Liquity in November 2019. Robert, now the stage is yours. Please let us know what Liquity is all about.
Thank you, Moritz, and thanks for having me. Hi, everyone. So let me share my screen. Can you see it? Maybe present. So let me know if everything is
Yes,
fine.
perfect.
Cool. So yes, as you said, Liquity is all about creating a decentralized borrowing system which issues its own native stablecoin, which will be pegged to the US dollar, like most existing stablecoins. Yeah, I would like to give you a short overview of our system, and I would like to focus on the price stability aspect of liquid US dollar. That's the name, or LUSD, of our stablecoin. And if there is time left, I would also cover how we make sure that the system stays solvent. So how we liquidate the positions when they become under collateralized, basically. And then if hopefully we can get into a lively Q&A session. Sure. So great. Let me start with like a quick comparison of like existing CDP platforms and Liquity. So MakerDAO would be like an example for an existing CDP platform. There are a few others, and they are all like mainly based on the idea that there is a variable interest rate for the loans, and there is some kind of governance mechanism that sets or adjusts the interest rate. And on the other hand, the stable coin itself that those systems like issue is not redeemable at face value, or just not redeemable in general. So you cannot, as a holder of the stable coin, you cannot come to the system and say, oh, I want to get like this value from the system paid out in another asset. So the mechanism, the mechanism that these systems apply is, I would say, like something I would call a soft peg mechanism, because there is this expectation that the governance mechanism would try to keep the price stable. So whenever the interest rate goes down, loans should become more expensive. So there would be less growth of the monetary supply because there are less loans taken out and more loans will be repaid. So this should have like a stabilizing effect on the price by contracting the money supply. And also, if just the stable coin is worth more than $1, people who believe that it will come back to $1 because that's the long-term target, they might be inclined to open a loan because they know when they will have to repay it, the price will be probably back to $1. So it makes sense for you to borrow at a slightly larger value than the value that you would have to repay. And the inverse is also true. So whenever it trades below $1, it's just the inverse effect. So Liquity, on the other hand, is a bit different. So we are not relying on interest rates at all. So there is 0% interest charged, but we do have one-time fees. I will cover them a bit later, but they are algorithmically set. So there's no governance that would like control them. And in addition, our stablecoin is redeemable at face value against Ether. So Ether is currently or will be our only collateral. And that means that you have like some kind of way to redeem your token against Ether. And the fact that you can redeem it at face value means that whenever the LUSD stablecoin trades below $1, it makes sense for you to redeem, because what you will get back is $1 worth of Ether. So you can sell the Ether immediately and make an arbitrage gain. So this should create like something like a price floor. So when the price should immediately rebound whenever it drops below $1. And on the other hand, we also have a price ceiling at 110, because 110% is our minimum collateralization ratio for the positions. And you can also imagine that if you can get out a loan from your collateral, which is worth more than 110 or 110 per US dollar, you can sell it immediately on the market. So it makes sense for you to immediately open many positions or very large positions whenever the price of the stable coin trades above 110. So this should push the price back to 110. So this is the main idea. Now, maybe just a very quick overview. So here to show it in a bit more step-by-step way. So we have Bob, who is a borrower. He opens a trove, we call the position trove. So you have like a collateral in blue and you have a debt in red, which should be lower than the collateral's value. And then later on, Bob can repay, or whenever he wants, he can repay and get back or retrieve the collateral that he locked up. So this is the main mechanism, but we also have, as I mentioned, like a redemption mechanism, which allows any holder of our stablecoin lost here Alice is one of those holders, to basically give back one LUSD to the system and get back $1 worth of Ether. So now the big question is, where does the Ether come from that the system pays to the redeemer? And here is something which may seem a bit unusual, is it takes it from the positions. So it basically takes it from some borrower. Now, the borrower's positions, they are sorted by collateral ratio, and the system would just start like at the position with the lowest collateralization ratio, like the riskiest position that is closest to the liquidation threshold, and would simply use Alice's LUSD to repay the debt of this position's owner, and would give Alice like an equivalent amount of Ether collateral. So you see that there will be a remainder here which stays with the borrower. So the borrower here, even though he loses basically his collateral or some part of it, but the net loss should be zero. So it's like a zero-sum game for him, even though it might be a bit maybe inconvenient for the borrower. And so on, and the system, if that's not enough, the system would just proceed with the second lowest or second riskiest position, and so on. So now, I mean, we have those two operations on both sides, and what we do, as I mentioned, we take fees, like the system charges a one-time issuance fee, like a borrowing fee, basically, which is a percentage of the amount that you borrow. And it also charges a redemption fee on the amount that gets redeemed by whoever is redeeming. And the two tokens, or the two fees, they are like collected in a staking contract, and the fee revenue is paid out to the holders of a secondary token called Liquity token. Like they capture the revenue generated by the system. And as you can imagine, the issuance fee, as being a one-time fee, has a very strong effect on new loans or prospective borrowers, because if the fee is high, nobody would open a loan. I mean, it's not that, like with an interest rate, you know, on the long term, loans become more expensive, but on the short term, you may not be affected by this. But with an issuance fee where you have to pay like an upfront 10% on the loaned amount, while you know that you want to repay your loan, like let's say 1 month later, so it won't make sense for you to borrow. So having this issuance fee is like a monetary mechanism to stop the system growing, like to throttle its growth whenever this is needed to stabilize the price. And we basically, we use the rate of redemptions, like this side here, as a signal which tells us that, oh, now our currency is trading below the peg, because whenever it trades below the peg, it makes sense for people to redeem. So we can use basically the amount or frequency of redemptions as a signal which the system takes in order to basically determine both the issuance fee and the redemption fee. So they are both like dynamically adjusted based on the amount of redemptions. There is a base rate we would first determine, and then based on the base rate, we can calculate the two fees. So that's the main idea. And here to summarize, the price of our LUSD token should be squeezed between the price ceiling of 110 and the price floor at $1, even though the lower price floor is a bit fuzzy because we have this fee, the redemption fee, which might be added, which is the variable. So it can be that it may drop a bit further or a bit lower than $1, but it should be on the long run, it should hover around this $1 range. So yes, and yeah, this is another summary. We have like kind of an algorithmic intervention, a very hard intervention when it drops below $1, because redemptions would take place then, which should contract the money supply as the redeemed tokens, they are burned. So that's maybe important. I forgot to mention that those tokens that are redeemed, they get burned. So the money supply will contract, which should push the price back. And on the other hand, we have a maximally expensive monetary policy with zero interests and zero issuance fee by default. So if no redemptions happen, the system would make loans as attractive as possible so that the total monetary supply should grow as fast as possible. So that's the idea for price stability. I'm not sure, was it 10 minutes? Do I have a few more left?
You have plenty of time left. No worries, Robert.
Cool. Yeah, then I will quickly cover system solvency and then go to the question and answers. So system solvency is like a little bit a different problem. Here, what we have to achieve is that whenever a CDP, like a loan position, gets insufficiently collateralized because the value of the collateral drops, like the market value of the ether could drop, and it could also drop below 110%, which is our liquidation, the minimum ratio that you need to maintain. So what happens on existing platforms is that they either do a collateral auction where they try to sell off the collateral in a bidding mechanism, or they try to sell it off at a fixed price, take the price from an oracle, apply a discount, so like a fire sale mechanism. And we think that this mechanism, like it works, but it can be subject to, it's like fragile because it's slow. Like you rely on bidders. There should be like a good functioning auction market, otherwise it can fail. And auctions take time, and during that time, the value of your collateral can drop even further. So Liquity does it differently. It tries to do the liquidation instantly, like without losing time. And it does it by applying a two-step mechanism. Like the first step is a stability pool, and the second would be a redistribution mechanism. And this is really designed to be fast and efficient. There should be no need to find a buyer or a bidder to buy out the collateral. And also there should be no risk of further price drops. Now I cannot show you all the details how that works, but I can give you like a short overview. So the first step is a stability pool, and the stability pool can also be thought of as an insurance pool. So this is the main part of our stability pool, which can be pre-filled by anybody who owns lots or our stablecoin. So people can put their stablecoins in the pool, and now when a trove, like we call those positions troves, that's just a marketing name, when they drop below 110%, the system would liquidate them by taking the debt out of this pool and burning the tokens. And at the same time, the system would give whatever collateral is still in that position, it would give it or send it in another pool, like an ETH pool. And whoever made a deposit to this pool would lose like a proportional share of his deposit with every liquidation here, and would gain an equivalent proportional share here. Like you lose some of your LUSD tokens, but you gain some ETH tokens. And due to the fact that we are liquidating slightly below 110%, there should be a net gain for you, because you lose basically 100%, but you gain something a little bit less than 110%, maybe 108 or 9%, depending on the speed of the oracle. And yeah, and then if that fails because the stability pool is empty, I mean, that can happen in case of like a black swan event, then what we would do is fall back to a redistribution mechanism where we simply take the position that failed or that gets liquidated and just proportionally chop it up or create chunks and give those chunks like to all other positions in the system. Like everybody who is a borrower would receive some portion of the debt and some portion of the collateral from this liquidated position. Like they are acting as kind of guarantors of all, like everybody's a guarantor of everybody else in a sense, but only as a fallback. So this should happen like rarely, at least, hopefully. And then if in case of a total disaster, like in case if the system's total collateralization ratio drops below 150%, we would apply a recovery mode, which has some special rules how we do liquidations. I won't go into details here, but liquidations would become more relaxed. So more positions would be up for liquidation. So people should behave in a way, even before the system would reach this kind of critical state, people should behave in a way that they would try to save their positions by either repaying their debts or by topping off their collaterals. So this is like an ultima ratio, which we hope that will never, ever happen. So yeah, that's it. And I'm here to answer your questions.
Oh, great. Thanks a lot, Robert. I remember that once we talked about that, you said like one of the unique, let's say it's called USPs of Liquity is the low collateralization ratio of like 110%. Now I saw 150%. Can you clarify that a bit?
Sure, I'm happy to. So we have basically two constraints or requirements. The 110% is for you as an individual borrower. So you have to maintain this. Otherwise, you get liquidated. But then there is also this 150% ratio, which applies to the average, like basically to the total, to all positions in aggregate. And now there is this kind of extra risk when the system drops below this 150%, that you as a borrower, you would then also maybe like subject to liquidation, even if your own position has a a collateral ratio of between 110% and 150%. So we liquidate up to 150% if the total collateralization of the system is below 150%. If it's above 150%, you are safe with your position that's at, let's say, 111%.
Mm-hmm. Okay, but I'm not sure if I got that right. Sorry, I have to dig a bit deeper. So I have to put up, if I borrow something, I have to put up like 100% as a collateral.
Mm-hmm.
How do then the system reaches the actual 150% if every other borrower also only puts up 110?
Yeah. So the aim here is that nobody would really want to keep its position at 110%. We are not expecting people to really to be in this kind of very dangerous range. It's more like an extra buffer that you have. So if your position like temporarily drops below 150%, you should be fine. But we still expect that people would try to keep their positions above 150%. But they can still sleep well during the night because they know if they just temporarily drop below 150, it's still fine.
Okay. So at the end, who actually provides then the liquidity? So okay, I got it. It's then basically the borrower that makes the up until 150%. So there's another question by Professor Berentsen asking if you charge a redemption fee, the stablecoin will continue to trade at a discount, isn't it?
That's right. So whenever the redemption fee is larger than 0%, there will be like a slight discount here. So that's why we have this light blue area. So we basically allow it to be temporarily like slightly below $1. So we don't take stability maybe as like strict as other protocols. So we are not striving to like become the perfect stablecoin. We want it to keep within a reasonable bandwidth or range.
Okay. Yeah, because I'm also wondering. So here you have a range of 10% basically, right, from 1 until 110.
Mm-hmm.
Is it still then like considered stable?
So here maybe I should mention that we still have all or part of the mechanisms that other stablecoins have, like MakerDAO, which involves the soft peg mechanism. We have them here as well. So we are just trying to add like an extra hard price ceiling and the price floor on top. But in between, there is still this kind of expectation, or there's still this kind of mechanism that as long as people expect that this works out on the long run, they should rather behave in a way, or the market should price LUSD at a price close to $1 most of the time. Of course, there can be temporary outbreaks, like where the demand like suddenly surges or drops.
Mm-hmm. Okay. Like regarding the establishing such a coin in the market, how are you bootstrapping Liquity? What are your plans there?
So we have like a plan of decentralizing the front ends, where we would not even run our own front end. So we would incentivize third parties to basically install like a launch kit that we give them, so they could basically or integrate the system within their own platform. And they would be financially incentivized because they would get this secondary token. Like there is like a community part, sorry, of this Liquity token, which should capture the value. So we give a part of those tokens to the front ends, which help bootstrapping our system.
Yeah, maybe a bit more tangible for the audience also. What could these front ends look like?
So yeah, a concrete example would be Zerion or Dapp or Argent, like those wallets that already have like an inbuilt support for other like Compound and other DeFi projects. So this would be one way. And the other way is that we are just designing our own front end, which then can be used by anybody. You don't even need special skills for that. You can just install it on your own web server, and then you can collect basically those tokens that we give you as a reward.
So then you address mainly here developers that provide these applications, these front ends.
Yeah, I mean, you don't
right?
need to be a developer. I think if you opt for the version the version that we provide, you don't need like special skills. It's relatively like a web admin should be able to install it on a computer.
Do you see like compared to DAI and other stable coins, do you see like edge cases or special usage of LUSD?
So we think that people who are a bit who prefer like a fully algorithmically governed system over one which has an inbuilt governance, and also people who prefer like a single collateralized, like a system which is only backed by Ether, that cannot just add other coins like centralized tokens, for example, as collateral, so that there will be a demand, like maybe purists who are not happy with being invested or holding a stable coin that is backed by other tokens that may be centralized.
All right. So I've got a final question then. When can we expect you to launch?
So we are expecting to release, or our plan is to release this in Q1 next year. So probably rather March than January, but that's the plan.
All right. Yeah, super cool. It's also great to have you on board here. So right now, let's sure. So from the design basically to the actual operation of a stablecoin business. And here we are very happy to welcome another member of the Swiss ecosystem, Armin Schmid from Swiss Crypto Tokens. They offer the so-called crypto franc, a fully collateralized Swiss franc stablecoin. Armin joined Bitcoin Swiss in April 2018 as head strategic projects before he actually became the CEO of the founded daughter company Swiss Crypto Tokens AG. Armin, now over to you. I'm really curious to see some lessons learned from operating a Swiss stablecoin.
Yeah, with a great pleasure. I'm happy to talk. Can you hear me?
Yes.
Excellent.
Perfect.
So I'm happy to talk here. Thanks for the invitation. Thanks for the opportunity. So Swiss Crypto Tokens is a daughter company from Bitcoin Swiss, as you mentioned before. Thanks for the introduction as well. Back about 2.5 years ago, when I joined Bitcoin Swiss, we said, hey, we need a stablecoin. We need a stablecoin based on Swiss francs. And by the way, I do not have any slides, so you just have to listen to me. And you can basically think about the questions we can have in the Q&A session afterwards. So we basically said, hey, we need a stablecoin based on Swiss francs. We would like to make sure that we have a digital Swiss franc available to power somehow the blockchain economy, to make sure that we have, for example, the opportunity to interact with a smart contract. And so there was no digital Swiss franc available back in the days. An important element would have been the on and off ramp of fiat to crypto. And then obviously also a fast settlement between a couple of parties. So just to make sure that you don't have to leave the crypto space, similar to any other stablecoin. And then in the end, if you would like to leave the crypto markets without leaving really crypto, you still can switch between volatile crypto assets to a stablecoin in Swiss franc, obviously, because the Swiss franc is a very stable currency per se. And I think the important element back in the days was, and I give you a little bit look into the sausage making here. So we really tried to come up with some good ideas. And back in the days, it was kind of difficult to really, based on a regulatory setup here in Switzerland, you just don't want to go to any strange jurisdictions. we said, let's do this in Switzerland here, based in Swiss franc. And so we had night and days of discussions happening. What can we do? How can we do it? Do we somehow store specific nodes? Do we do it on gold? Do we do some whatever collateralized setup? And as you have learned today, we have some very complex setups. We have some very concrete decentralized setups. What we have done is we have a fiat collateralized setup chosen. So we basically collect the money, put this in our safe. I can give you a little bit more details about this. And then we issue a stable coin, which is one-to-one pegged to the Swiss franc. And I think there were a couple of reasons why we have done it like this, but quite an important element actually was that we said we want to do this without a banking license. So we were able to put something from a legal setup the right way. We tried also to reduce a little bit the cost of the negative interest rate, which, and I come back to the learnings, which is kind of an issue here in Switzerland because someone has to pay for this. I also would like to say that the setup based on the token itself is, be it also a little bit linked to a stability setup, that you have a Swiss node in a bunker, for example, that at least represents somehow a real value, not similar to any, for example, decentralized and crypto collateralized setup, where we don't really know what you're having. Based on Alex's setup, where Bitcoin Swiss does not have an where Bitcoin doesn't really have an intrinsic value, how can another cryptocurrency have an intrinsic value? And therefore, if you want to have a stable coin, you definitely have a real value underlying based on a banknote. It had to be really transferable as well, which was an important element as well for us. So no private blockchain; it has to be on a public blockchain. And then we came up basically with the following setup. First, it is a standard ERC20 token on Ethereum. Nothing special, plain vanilla ERC20. The only thing we have built in, which is kind of complex, was a melting functionality. So in case of we would have a huge volume, and we would have to somehow make sure that we align monetary policy, also make sure that we have a negative interest rate, that we could start melting the token. So the so-called melting functionality is built in. Second, quite important is that we are representing one-to-one to the Swiss franc. So we have the underlying is a denominated bond. In German, it's called Anleihensobligation mit Prospekt, where we are actually allowed to get the money and issue the bond, and the bond issuance is based on the tokenized crypto franc. The cash is held in physical banknotes. As I mentioned before, it represents obviously a core value of the token itself, but also gives us a little bit a better cost ratio in storing those tokens rather than paying the negative interest rate on a Swiss bank account. And quite important, we are monitoring and auditing the underlying assets on a monthly basis by Grant Thornton, and issue this report in public. And I think that's an important element to show the trust. Back in the days when the question was related to Tether, is the money really there or not? This was the reason why we said we want to have a very regular update. Yes, the money is there. Yes, the company is safe. Because in the end, if you issue a bond, you give me the money and I give you a token, and you have to trust in me. That's definitely one of the issues we have in the setup compared to any decentralized setup. Because it's a centralized setup, you have to trust Swiss crypto tokens and maybe my mother company, Bitcoin Swiss. But in the end, you have to trust me. And therefore, we add the trust to the outside world with a monthly audit by Grant Thornton. And I think this was the important setup. From a conceptual and then also from an implementation perspective. We are live now for close to 2 years. In 1 month, we have our 2-year anniversary, and the volume went up a little bit, went down, but in the end, we have currently 4.7 million tokens in circulation. What is the business model? And I think that's also a big element of the question mark here around the learnings. The business model is based on issuance and redemption fees. And with this, I would then also be able to cover my cost, for example, the storing cost, but also any other costs, for example, related to the monthly auditing costs by Grant Thornton. Where are we today? After close to 2 years of having this token currently in circulation, we have done it. There aren't that many companies who said let's do a Swiss franc backed stablecoin and really issue it and do it. And so I think many people are talking about it. I won't mention names. Some others have done it and they're no longer available and around, but I think we have done it and said, let's do it. And let's make sure that we have a Swiss franc, a digital back token in the market. And we have had also some successful transactions. So I would like to mention at least 2 or 3, which are quite important. One is we have done a tokenization of a real estate building here in Bar, next to Zug, where we have had done this together with Blockimo, a company here also in the crypto valley. And in the end, it was a successful proof of concept that yes, you can do this. Yes, you can pay with a digitized Swiss franc into a smart contract and get the token out and vice versa. Second is a company called Aleksander. They have done a share dispenser based on our token, where we need a Swiss franc based token and not a US dollar based token. And right now the company went over to another company called Aktionariat.com, where the assets basically are continuing to be available. And then we also have done storing Swiss francs off balance sheets, which is quite an important element also from a perspective that if you would go belly up as a company, you can say, look, those off balance sheet elements are definitely you, and so you're not part of the company itself. Yes, we also have been able to reduce some negative interest rates issued by a bank. And therefore, yes, this was quite at least something there. For me, and a biggest learning as well, and I was listening quite carefully to the very interesting discussions, especially with the crypto collateralized and more complex setups compared to my very basic setup. You take a Swiss franc and you get a token out. Stable coins, for me personally, are there to power a wider ecosystem. And I think this is where I believe, especially the DeFi space is so great, because in the end, yes, you can make some positive returns. So the yield definitely is there. Also, for example, having new blockchains like Tezos or others, where you have a staking reward. And therefore, I believe stablecoins are there, especially based on Swiss franc, but you need somehow to make the money somewhere else, because you need somehow a positive return with a different token. We have a Swiss franc based stablecoin, which is not a US dollar based stablecoin. Most of the economy is in US dollar, and that's kind of a challenge, especially, and that's my next point, with the negative interest rate of 0.75%. The business case is kind of tough. And you have to be really careful that you can also power somehow such a setup. Yes, we don't have that many tokens out right now, so 4.7 million. I'm happy to cover this cost, but in the end, if you would go into the triple or even triple digit numbers or even higher, obviously this would be quite costly. Having the cash in the bunker is a good solution, and really has the setup as a collateral is really there. But the question there is there an opportunity to make a little bit more than just storing the cash? It would change a little bit the system behind the token itself. But in the end, if you always get somehow the money back, what you would like to get back, I think this is still an option, at least to make the case slightly more positive. Alex was also talking about CBDCs. They have to be definitely retail-like. So I'm not really interested in any wholesale central bank tokens issued. We are looking for something which can be really used in a wider adoption of the market. And so if there is someone coming out with a Swiss franc stable coin, I'm more than happy to say I'm reducing my volume to whatever a nice little piece. But in the end, it's important that such a token based on Swiss franc is available, because the economy in crypto is, yes, mostly in US dollar, but I think from a Swiss franc or even euro perspective, there's also a stable coin needed. Going forward, and then I'm concluding basically my little discussion here. Going forward, we are looking into powering other blockchains, not only Ethereum, because in the end you can copy paste this into another blockchain. That's quite easy. The cost base is something we have to make sure that we are. Can you still hear me?
Yes,
Yes.
yes, we can.
I see now a screen here with a lot of icons.
Yeah, it was Cilio's screen.
Anyway, yes, different blockchains, the cost base and investment opportunities to make the case more positive, and then new tokens where you also can get a positive return. For example, because in the end, the smart contract is built that you don't not only have a negative interest rate based on the melting functionality, but you also can get somehow an airdrop opportunity for specially qualified tokens. So we're looking into those elements, but also because I'm having the hat as a head of payments at Bitcoin Swiss, we're also looking into offering the ERC20 based tokens in our payment functionality. So let's see how the journey will go on. And that's it from my side.
Cool. Thanks for this quick overview and your learnings when it comes to the to your stablecoin that you offer. I'm wondering if you could quickly explain again this bond-based model that you choose to issue the tokens.
Well, one of the questions, how you can somehow accept money without being a bank. There are a couple of exceptions, and issuing a bond is one of the exceptions based on the law. And I think that's one of the important learnings I have had to go through in the last years. I'm an engineer, I'm a consultant, I have an MBA, but I'm not a lawyer. And if you do something in Switzerland, you have to do first, check the law, second, check the law, thirdly, check the law. And I think technical, it's all fine. But if you want to work in a legal framework here in Switzerland, better make sure that you understand the setup, because I think it's important if you'd like to grow. And I think that's an important learning as well.
Does it come with any disadvantage if you choose this model?
Yes, of course. It is qualified as an asset token here in Switzerland based on the FINMA ICO guideline, and therefore it is not that easy to trade without having a broker-dealer license. And therefore, that's one of the reasons why we're looking also into payment token setups.
But I mean, like, I guess Bitcoin Swiss itself, they have a bank license.
We have applied,
but not a subsidiary.
And the bank license.
You have applied, okay.
So we have applied for 2 licenses here in Switzerland and the third in Liechtenstein. So one is the banking license, so you can do the active money, so you can also give credit out based on your funds you get from your customers. The second is that you can trade all tokens, therefore the broker-dealer license is needed. And to jump internationally, we are applying for a banking license in Liechtenstein to get the passporting to the European Union.
So would you choose the same setup again, or would you adjust it, assuming you got these licenses from the beginning?
Oh, with a license, everything is much easier, definitely. But since Bitcoin Swiss was not a licensed entity, yes, but you're perfectly right. With a license, everything is much easier. But there aren't that many banks who really dare to touch crypto at the moment. and therefore we will see how this is going to evolve in the coming months and years.
Mm-hmm. Are you actually doing KYC on redeemers and issuers?
Yes, 100% KYC. Swiss Crypto Tokens is also part of the VQF, self-regulatory organization. So all issuance and redemption are fully KYC'd, including the full Monty. And that's how you are doing it. So on a bond issuance and redemption, that's exactly what you have to do. But you're allowed to do trades of bonds without doing KYC. So I can do a peer-to-peer transaction, so that's fine. But if you want to redeem it afterwards, I just do the full KYC.
Okay, so then the no KYC obligation for asset tokens only refers to the trading, but not for issuance.
Exactly, and that's the same. For example, when you're ABB or when you're Siemens or someone else, and you're issuing a bond, you can exactly do this. So you have no hurdles actually to also share this bond with someone else, and therefore we do exactly the same. So that's 100% according to the law.
Mm-hmm. Like now I have to dig a bit deeper because I'm also very super interested in it. That I'm not sure if you can actually disclose that, but can you say something when it comes to who are the actual holders of the coin and how do they use it?
Maybe that's something I'm not able to share. But as I mentioned before, my use cases, I was talking about tokenizing real estate. I was talking about tokenizing shares, so the share dispenser. I also said that we can store crypto off balance sheet, and you can go in and out of volatile crypto assets. Maybe that's something that sums it up.
Mm-hmm. Okay, thanks. Okay, then one final question: is there any insurance that you provide for the cash that is deposited with you?
What do you mean with insurance?
Like against bankruptcy?
So that's exactly what I'm doing on a monthly basis. So I'm providing a monthly statements paid by my company and also published on the website that we are over collateralized. So we have more money on our balance sheet than tokens outstanding, and that's the big positive actually about the stablecoin we are currently having, because we have always the money available if you would like to come back to me and redeem the token. So the insurance basically is my company and the monthly statement of a audit company that says yes, the money is there.
Mm-hmm. I think it's a great way how to tackle this transparency issue, especially if you compare it to other players in the market. All right, thanks a lot, Armin, for these insights.
Happy.
So now before we continue with our panel, we will be hearing another talk that rounds up quite well the first part of the day, I would say. Have you ever actually wondered how stable coins are, and what do we actually consider stable? So this topic, together with a more critical rethinking, is discussed by Akseli Virtanen. He is the co-founder of the Economic Space Agency and co-author of the economic paper Protocols for Cryptoeconomic Networks. Yeah, and it's super interesting that you joined us here, Akseli. So please share with us your thoughts about the stability of stablecoins.
Cool. Hey, thanks, Moritz, for the invitation. This is really, really nice to be here. And gotta say, really interesting talks. I had, in fact, questions, but I thought that let's keep the Swiss timetable and not go into this, but especially the collateral aspect really interests me, kind of for what the projects or kind of showcased here, what they are able to do. And I think they would be able to do something even more radical. They're on the way to some very interesting things, I think. Anyway, so I'm a political economist and a finance theorist, and I've written quite a lot about the history of economic conventions, monetary conventions, like in the Greek thinking in the 14th century Italy, in the 18th century, 19th century, the birth of the joint stock company and the stock exchange is kind of for. And if there is a like a message that I've learned from there is that that economy has a history. Like what we think, how it works today, it has not always worked like that. What we think that what's the value and how it gets defined, it has not always been like that. And to me, it kind of points to a very clear conclusion that if economy has a history, then it most likely also has a future. And that's kind of the perspective from where I am coming on, and our work at the Economic Spaces Agency, where we are coming from. And it's kind of important to see that the actual condition of the crypto economy right now, like what's the point? We need to situate it also into this breakdown of the conventional economic knowledges, like for instance the breakdown between the blurring of the distinction between debt and equity, the new liquidity in asset markets, like through the derivatives, like some other assets are gaining like moneyness and things like this. And I think that really it's to be able to be part of this moment and kind of in engineering and thinking and designing this new coming economic forms, that just makes me like super excited. So this is also our perspective to stability, what I'm going to talk a little bit today. And we would like to put stability in motion. That's the aim. I'm going to share my screen. I'm gone. Cool, you see it, right?
Yes.
Okay, I'm gonna move that there. Do I see me? Okay, it's better. Cool. So towards new framings of stability. That's the topic of the talk. What I'm gonna try to address a little bit. And also, if I may, we also been thinking like what comes after DeFi, and I'm trying to point to that direction. So, oops. What is stability? Yeah, I was a little bit surprised that nobody even mentioned it or tried to figure out or thought about it like stability in respect to what? Like what does it mean? Like what is the appropriate benchmark for stability? Like whose stability? The environment stability, global warming, the poverty relation in relation to the poverty. Like what is the appropriate benchmark? Or what is the, let's say, okay, so why is the USD or the Swiss franc considered so stable? And this leads to my second point, is that it's considered stable because it encodes and enforces the socially dominant ideas of what constitutes value. So money is not really a thing. Certainly, it's not just one thing or just a technical mechanism, but it's a social relationship. So it always codifies the existing social relationships, like an ownership or capital-labor relationship, or the profit as the measure of value. It's kind of what I mean by this, that money is a social medium, is that money expresses certain sociality. So if you think of it expresses a certain network, an economic network where there are certain agents interacting according to certain shared agreements, certain protocols, it expresses always that. So in a sense, Bitcoin revealed this to us. So it kind of identified the trusted intermediary component of capitalism. It showed that capitalism is a system of verification, regime of verification, which depends on faith, and this faith again depends on violence and coercion. And it saw that there is a place for a little bit more freedom. But what it did, it showed that the value has an organizational, institutional basis. It revealed that to us. It unleashed the sociality of value. But it didn't really give us the language to express this sociality yet. So Ethereum, it kind of opened our imagination for the possibilities of such language, but it's not yet that expressive. So we, for instance, at the Economic Space Agency, this is what we are working on. We're working on a grammar for expressing new social value forms. So an economic grammar that expresses these different socialities, what we call social derivatives. Okay, but now I'm getting a little bit ahead of myself, so let me get back to the topic of the talk, which continues from here. So here we have Ben Bernanke, who gave in January this year. He was at the American Economic Association, and he gave this talk. He came out with this talk on the new tools of monetary policy. And I had added the rainbow colors there because in this talk, what he actually does is that he redefines what normal means in monetary policy. So there has been like a lot of commenting around this, and I think that the conclusion, the shared conclusion of the comments has been that it's a fact that we've entered a period where the conventions of the state monetary policy no longer work. So I'll just run you quickly through this. What does it mean? So first of all, the official interest rates, they've been cut so frequently in an attempt to trigger economic growth that they have gone negative. At the moment, there is USD 14 trillion bonds trading at negative yields around the world. I mean, borrowers are being paid to borrow. Savers are paying for the privilege of housing the savings in the bank. Then the second shift that we see now, governments keep forcing the austerity on the populations, but continue to stand ready to pump liquidity into the financial markets. Now, what is going on in the COVID-19, it will just aggregate this development. At least in Finland, the politicians have already started to talk that about the coming austerity, and we know who will be suffering from that. Thirdly, central banks. I mean, after the financial crisis in 2007 and 8, they started to pump up the deflated asset markets, and they promised to release those assets back to the market, but they can't do it. So right now, the next crisis and the next economic crisis will come. They will be facing it with massively inflated balance sheets, and with no new strategy to deal with this crisis except for buying more assets to inflate the asset prices. This is Bernanke's new tools. So they're kind of so committed to guaranteeing the liquidity that there's little else they can do. which makes the central banks a little bit like hostages to financial institutions, which are known to generate illiquidity either via distortions in the market, like in the Libor crisis, or in the repo market crisis in the mid-2019, or then the 2017 when there was a clear misrepresentations of the risk. And finally, the base interest rates, meaning the overnight rates, which are thought to be risk-free, they are not actually working. So in the US repo market, there was a sudden illiquidity late into 2019, required massive liquidity injections from the Fed, Libor, the overnight interest rate, interbank rate quoted in London, thought to be the most important number in the world. It's going to be abandoned. I mean, it was found corrupt. It's going to be abandoned and replaced by a derivatives index by 2021. Now, these historical shifts in the foundation of money, and I could go on, but they signal some serious challenges to the conventions of money. First of all, we can say that central banks are really not controlling the money system. I mean, their agenda is to generate stability right now, but they can't deliver. It's out of their control. This was Bernanke's message. They are out of tools. So they can't deliver. At the same time, we know that big finance is no longer actually centered on borrowing and lending on debt. But the big action in finance, it's around volatility, which means that the big finance, I mean, they're making money out of the uncertainty and the volatility, the precarity in the social relations. And these 2 points are not at odds. So the central banks are struggling to secure the financial stability, and the financial institutions are profiting from this volatility. They are not at odds. This is the system, and it is not stable. So our conclusion kind of is that we actually need different framings of stability, which invite the questions where I started, like stability in respect to what? What happens if we start to focus on this, on the potentiality to see the state's money as unstable by its own historical conventions? Who makes the call what is stable, and in whose interest is that call made? Now, this is the light in which we need to think about the stable coins too. So being stable in relation to a fiat currency or a basket of fiat currencies is certainly, it's one take on stability, but embeds the primacy of the fiat over crypto and leaves the instability of the fiat unquestioned. So my question, or our question we've been trying to think, is that where do you go? Where do you go when you want to dissent from USD, when you want to dissent from fiat? Where do you go when you want to stand against it, when you want to stand against the social relations that they encode? When you want to short it? Where do you go when you think that the social relationship it encodes is a cultural financial asset in decline? When you think that it's dangerous in the way that the current system shorts the environment and our qualitative dimensions of our life, like where do you go? And this is where we think that the real potential of crypto economy actually is. That we can start to rethink, re-engineer the sociality of money, to make it express different social relations, to create new kind of stabilities, social relations and processes that we believe should be constant, and new metrics of stability. So So just to end quickly, kind of from my perspective, and I think that what the DeFi is doing and the direction it is going, it's not that big of a leap to start asking the question or going to the direction that what is I think that every DeFi project coming up next should ask, like, what is the notion of the intertemporal stability that it claims to secure? And that stability must be a statement about self and not others. To these words, Moritz, back to you.
Thank you. Actually, that's a word at the end. It was I think we gained quite a interesting like first glimpse of a totally different perspective on this topic of stable coins. And yeah, maybe like a short question at the beginning. So you published this the article "What is Stability?" I think back in January. And
Sure.
Looking back, it was actually a quite a interesting time back then, because that was actually right before the corona crisis happened, with all these severe impacts on the global economy, and already back then you pointed out to very much inflated asset classes.
Sure.
And then now the central bank sort of announced a new normal, right? And developments over the last months even reinforced the activity of the central banks, meaning issuing more money. What do you think are ways out of it, actually? Like concrete ways?
For the current economic system?
Yes.
You mean? I don't think there is a way out. It's gonna end badly. That's what I think.
Okay.
And that points kind of if there is a chance, it should be like the actual potentiality of the crypto. It actually opens the economy as a design space. We can actually start to engineer different kind of stabilities, different kinds of like economic and social relations, express them, and I think that is not only the future, but the way to start shorting the existing system. I mean, if you really take the long historical perspective, first of all, I think that kind of it's not the inflation that's the problem. Historically, it has not been. It's rather the opposite, that there's not enough inflation. Really, in the long term, historically, in historical perspective, I mean, there's a lot of very good evidence that when the new emperor took power, he forgave all the loans, or at least part of the loans. And one of the key problems in the current system is that something like that is not possible.
You also mentioned DeFi in this context. Could you just like summarize what is your perspective on DeFi? You also mentioned what comes after DeFi.
So maybe I can. You referred to this. So we've been working on this paper. By the way, if somebody's interested in this stuff, I'm really happy to share. We haven't really shared this yet publicly. I'll show you. It's we call it an economic paper called the Economic Space Protocol. It's like a grammar for post-capitalist economic expression, or protocols for post-capitalist economic expression. And this is kind of where it's quite a lot. It's like a little bit over 100 pages, but if you're interested, I'm really happy to share it. Just message me. And we are kind of trying to precisely to think there that what comes after DeFi, in a sense, and it is
already after DeFi, or do you see DeFi as a way out of that?
Well, in DeFi is in a sense a little bit conservative, I think, in the way that they what it does, on what it concentrates. I think that if we think of capitalism as a financial systems, there are three questions that really define it. It is the question of the collateral. What is what is accepted as collateral, what counts as collateral. This is something that the DeFi projects have started to explore in a very innovative way, and it's absolutely the right way, I think. So what counts as collateral? Then what counts as liquidity? Another really, really important question. Like what counts, what kind of value productions are allowed into the information accounting system to start to circulate as value? And then the third one is that who decides them. So I think that the like the DeFi protocols are kind of going to this direction already. They are like opening in a really clever and interesting ways the questions of the collateral and liquidity. But if we look at again historically, like money, it was maybe invented in 700 BC. From money, we go to banking, 14th century Italy. It was the banking protocols was invented in order to allow the long distance commerce to make that happen. And from there, what was the next step? It was the large scale industrial productions and its fundings. So in a sense,
Right.
if we think about the crypto, we can this history of 2,000 years kind of collapses into 20 years. So we have money, new money. Now we have new banking protocols. So what is the next step? It must be the production. Like what kind of new forms of production, new forms of values are going to be produced? That's our bet.
Wow, great. Thanks a lot. I can really feel your passion about this topic. Thanks a lot. So this talk now concludes the first part of this event. With that, I would now like to hand over to Florian, who is moderating the first of our two panels.
Thank you very much, Moritz. So I welcome you to the first panel tonight. We have now heard a lot about different designs of stablecoins, some issues that are still there, but also the potentials. Now in this panel, I would like to, together with my panelists, dig deeper into the big questions, particularly in the economic questions on stablecoins and their regulation. Both are crucial factors for the further development of stablecoins. So my name is Florian Spichige. I will be your panel moderator, and I am very happy to have my panelists with me tonight. I will give a short introduction to all of them, and I'll ask you kindly to quickly say hello. So we first have Dr. Thomas Moser. He is an alternate member of the governing board of the Swiss National Bank. I'm very happy to have you. Welcome, Thomas.
Hello, thank you very much. Thank you for having me.
Perfect, thanks. Then next from Signum, probably you know them. It's one of the first crypto banks that have received a banking license in Switzerland. We have Martin Burkherr, Chief Client Officer. Signum has also issued their own settlement token pegged to the Swiss franc. So hi, Martin.
Hello, everyone. We were the first, so it's important.
You are the first. Okay, sorry. Perfect. Yes, thanks. Then I'm also very happy to welcome Eli Dutfort from Globcoin. Eli and Globcoin have issued the GLX payment token as backed by, if I'm not wrong, 15 different currencies and also gold, so making it a global coin. Salut, Eli.
Hi, everyone. How are you? Good to be with you.
Nice to see you. And then finally, we have Aleksander Suhobokov from Dukascopy Bank. Dukascopy Bank is also right now planning to launch their own stablecoin. Happy to have you here, Alex.
Thank you very much, Florian. Hello, everyone.
Thanks. So I'm very happy to have you here, guys, and to discuss these exciting topics with you. So first, Aleksander Berentsen told us that Augustin Carsten from the BIS said, stop trying to create money. So here the question, I would like to explore this a bit more. What kind of risks or opportunities do you see if we shift the creation of money to the private sector? So, Eli, do you have a take on this?
Sure. Well, I think we'll have a coexistence of several ways and several methods of payment. We'll have certainly CBDCs in some countries. We'll have private issued stable coins. And we have, you know, obviously classical banking way of payments. But the thing is, the technology is there. So let's talk only on the retail side. There's a lot of demands, especially cross-border and other cases. I think we'll develop that further. The demand is here, the technology is here, and we're in a transition period where all the actors are looking which type of game they will play and how they will interact together.
Okay, thanks for that. So maybe Thomas, do you have, can you give us your view from the maybe side of the national bank?
Yes, you started with a quote from Aleksander Berentsen quoting Augustin Carsten. Yes. So the next thing that Alex, and I know he's somewhere here tonight too in this conference, the next thing he would tell you is that privately issued money is nothing new. And as has just been mentioned, commercial banks have been doing that for quite a while. So if you pay with your bank deposit, then this is a privately issued money. So the coexistence of state money and private money has a very long tradition, and I also think it serves the economy very well. The role of the, I don't know, can you hear me?
Yes, I can hear you.
Yeah.
The role of the private sector has usually been innovation and making products very consumer friendly. And then usually the state's role has been to regulate and make things again more secure. And I think that's something we have seen in the past. And I think that's also playing out right now with stablecoins.
So yeah, to follow up on that, maybe, so as you mentioned, there are many ideas to issue some CBDCs. So Lagarde, for example, has set up a task force for a digital euro, and there are also two professors from the ETH, Professor Wattenhofer and Professor Gersbach, that are calling for an e-franc issued by the Swiss national banks. So what effects will that have on current stablecoins project? Can they coexist, or will the stablecoins project die out? What is your take?
So I think the central banks are really thinking about two types of central bank digital currencies. One would be limited just to selected financial market participants. And these players already have bank accounts with central. That wouldn't be very disruptive, I think. And but there the question is, if you have financial market infrastructure coming up on blockchain technology, then clearly that a CBDC would take away business from stablecoins right now. Now, if you have a DLT and you want to pay on a DLT, the cash lag is usually handled by stablecoins. If you bring in central bank digital currency, that clearly could take the place of stablecoins. Then when we come to the retail side for CBDCs, there I think the central banks are much more cautious, because there is a risk or a concern at least that you could disintermediate the banking sector. If you make the CBDC, if the CBDC basically replaces bank accounts, then you have an issue with the banking sector that you have to deal with. And I think that's why central banks are relatively cautious to move forward on the retail side.
Right, thanks for that. So if we think, today we have seen all these different projects, so we can imagine a future of multi-currencies where we have the multitude of different complementing or competing stablecoins. What is your opinion on that, Alex? Do you have something to say about that?
Yes. Hello, everyone. Again, I'll share my opinion, the opinion of Dukoscopy Bank, and I think it will partly cover previous questions as well. So we indeed we have a project on the stablecoin. We started thinking about it, I think, already more than 2 years ago, and submitted the application, the first one, to the regulator, I think, a year and a half ago. So I should say that at that time, we believed that stablecoins should, let's say, follow the normal evolution of a new financial product, right? Which what we mean by normal is that when something new is started, then there are first interested service providers, first interested clients. There are lots of experiments, lots of innovation in this area. Then some of the projects, they become more successful. Let's say they survive, others do not survive. Then when these surviving projects, popular projects, grow in value, then normally the regulation steps in, and then there are some certain rule of the games that normally based on the prior history of this evolution, right? Unfortunately for stable coins, it didn't go this way. There was a so-called black swan, as Professor Taleb called this factor, and in this case it was Facebook, right, which I think derided the evolution of this instrument from, let's say, this regular normal path of development, and switched or pulled, this trigger towards a more regulative and conservative approach straight from the beginning, straight before this normal evolutionary process could have taken place. I don't believe this is generally a very positive thing for stablecoins as a new financial product, because historically, not only in finance, private sector was responsible for innovation primarily, because the public, it's not the role of public sector to innovate, obviously, but that's the signals that we see and hear here and there from the national regulators in the United States, in Europe, in Switzerland, other countries as well, China, that the regulators, authorities are ready to let's say take, or rather grab or squeeze, I don't know which word to use here, this process from the private sector. Regarding the multitude of tokens, well, the more the better at this first initial stage of development. That's what we believe. However, even if the regulation wins at this early stage, we still believe that, let's say, take a look at the European Union and their plans that we all saw in this regulative initiative. In any case, even I think at the worst case scenario, so they would allow local authorities in Europe to decide about the issuance of stable coins for the private sector, for some large players in it. So there are 27 member states. So if 3 regulated entities in each member state would be allowed to issue a stable coin, we already have, quite a lot. And we have several blockchains, popular blockchains. So there will be, more stable coins in each of these blockchains. So we're already speaking about hundreds of stablecoins in even under this regulative framework in Europe only, in Europe alone. So the competition will be there for sure. Doubtfully, there will be 1, 2, or 3 stablecoins from the beginning. Whatever happens, yes, there will not be 3,000. Most probably there will be, I don't know, a few hundreds of them.
Thank you very much. Before we transition to the regulatory developments, I would quickly ask Martin. So, what do you think if there are quite a few stable coins already out there? So, what problems are we actually solving with these stable coins?
I think it's a very good question. It's also the relevant question. And here I'm very much with what Thomas Moser said from the Swiss National Bank. So ultimately, these stable coins, they are here to drive innovation for new innovative financial products, probably also for new innovative settlement approaches, which make a few market participants that we have today redundant. Some infrastructure is probably no longer needed because we can solve regulatory challenges with technology. And I think in general, this multitude of stable coins is something which is very, I think, very interesting to observe how it's evolving. And it's also very interesting to observe what kind of problems the different stable coins try to solve. And for me, one point, which probably rather goes into the last question you asked, is like, how do we see these stable coin market today, and what kind of risks do we see with the different stable coins that are there? And actually, I think there we just recently, over the last 2 months, we saw that with these different stable coins being issued, we saw that there is apparently a price disparity between the different stablecoin projects, like what all these DeFi applications are doing with this yield farming between stablecoins. And I think there we have quite some systematic risk. And I think this goes then also into what Thomas mentioned. I think once these stablecoins reach a certain size, they out of a sudden turn from an experiment into some real economic risk. And I think there, I expect probably not in the next few weeks, but I expect that we see in the next few months that probably some stable coins, they do not turn out to be as reliable as we initially thought. Some of these liquidity pools probably collapse because they are heavy tails towards stable coins which are not as reliable as we initially thought. And I think then we will probably then also see what kind of stable coins turn out to be reliable enough to build the new economy on these new financial systems.
All right, thanks. So now let's turn to regulatory issues. As Armin Schmid said before, we should check the law at least 3 times before we do anything in Switzerland. But with regard to stablecoins, what do you think? Where does regulation go? As Moritz mentioned, the US regulator allows now national banks to hold deposits for stablecoin projects. But do you foresee a stablecoin friendly future, or rather a difficult future with respect to regulation? So, Eli, what do you think about that?
Maybe at the risk that there will be another video playing soon, let me quickly say about regulation. I think it's important to also keep in mind that the regulation is almost a little bit a sign also of success. I mean, as Martin just said, if you have these cryptocurrency stable coins and you have a niche group using them, then there is usually no regulation attached to it. But if it becomes a household item, and especially if you have then users who are maybe not that knowledgeable, then a lot of times the request for regulation comes from the consumers, comes from households, and it comes also from companies, firms who want to use this stable coins because they want to have this legal security when they invest in certain projects. So it's not just that the regulators come and want regulation. Often it's a request and exactly a sign that something is going mainstream. So I think that there will be clearly increasing regulation. I mean, on the one hand, there are the issues of KYC, anti-money laundering, that has to be taken care of, that these coins are not abused for illegal activities. And then there is the consumer protection side and the legal security that you need to do, make investments with them. So I think we are moving in that direction. It has been mentioned that some of the stablecoin projects are now backed by central bank money, and that's exactly the case in Switzerland with SEBA, Signum, the two. I mean, they use their accounts that they have with the Swiss National Bank to back their stablecoins. The issue here, of course, is that it's and it has always been with, if you have something 100% collateralized, the profitability is not that high. And then the question comes, do you move now into other collateral, into high yield collateral, and then it can become a liquidity issue, and then regulation can come in again. So it's a little bit, I see what happened to banknotes in the 18th and 19th century might replay now with stable coins, but that is an open issue, but that would be one possibility.
And maybe I can add to this, and I think that's effectively also what we observe from the market. So this regulation really adds value to a stable coin. Like, for example, today, I think we see especially large cryptocurrency trading companies, they try to avoid settlement risk, so they want to do atomic swaps. Now, if you do an atomic swap and you use an unreliable stable coin, I don't want to mention names, but I think all of us have probably rather unreliable stable coins in mind. Okay, so you trade off the counterparty risk of an unreliable stable coin against zero settlement risk. And this you don't want to do. So they are really looking into reliable, regulated stable coins in order to avoid settlement risk through atomic swaps, but also to avoid the systematic risk of an unreliable stable coin. So yes, regulation adds value. I think it's not only the evil. It would be the evil if we do a regulation for every 10 million stablecoin project. But if it's getting serious, it's getting into financial products, it's getting into large corporates, it adds a lot of value. And I think there is a high demand for properly regulated, reliable stablecoins. But if I hear that the fractional reserve one is probably also a good future, then I'm very happy to hear that.
Great. Okay. So
if I may also add to this question quickly, just as a comment, and answering to the question specifically about friendliness. It's clear that regulation in general is always unfriendly, and we all have to adapt. Even it is necessary. However, it's critical that the regulation does not become, let's say, a killing, weaponry. And what we observe now, so in front of our eyes, the global fragmentation is increasing, and obviously stable coins are planned to be used as a weapon in this, let's say, contest. We see how Europe is limiting its market for the issuance of euro stable coins. US regulators obviously are focusing on the same issue. The same happens in China. I don't know. It's the problem, I think, is that this new and innovative instrument with great perspectives might be used in a bit, let's say, incorrect fashion. let's call it this way.
Thank you very much. So I would like to give some time also to the audience to post some questions. So if you have some questions, please add them to the chat. In the meantime, I have a short follow-up question on the money laundering, what Thomas mentioned. So stablecoins enable digital payment. Stablecoins are built on distributed ledgers, often also on public ledgers. So what does this mean for AML? Is it positive, or is it or can it be used? Can it improve AML regulations or measures? what kind of implications does it have? Anyone has an opinion on that, or?
I think we have so many possibilities to address these potential money laundering issue through technology. First of all, we can build a closed system. We can have a whitelisting approach within a stablecoin project. So I think that's something, for example, that we don't have with paper money today. We have it to some extent with bank money today. And the other thing is also, it's immutable. So the blockchain is immutable. And this also means that we have quite some technical means to assess the history of all these digital money. So I think this one, if properly set up, is something that you can manage. And I think, yes, we proved that you can manage it, proved to FINMA, to auditors and all that. And I think it's something which is absolutely manageable. But yes, it is a risk that needs to be addressed, that needs to be taken very serious, because what we all want to avoid for Switzerland, but also for the whole digital asset ecosystem, is that we have some money laundering scandal about stablecoin. This would be very, very harmful, but I think it's something that you can absolutely master.
Thank you very much. Now, let's see if there are some questions from the audience. I check whether I missed it in the chat. So if you have any questions, then please add it to the chat. There is one from Robert Lauko. So the new EU regulation drafts MiCA targets the issuance of stablecoins and other tokens. So decentralized applications are developed and then deployed to a blockchain platform. Once that's done, there is not really an issuer anymore, and maybe not even an operator. Which entity is the right target to regulate really in decentralized systems?
I think that's maybe I say a word here. I think that's an interesting question, and that came up, I think, early with Bitcoin, where you also do not have an issuer, where basically the blockchain or the system is the issuer. Now, one interesting thing is in economics that you often see some kind of a tendency towards centralization, no matter how decentralized the system is. And what happened with Bitcoin, for instance, is that you had exchanges. So a lot of people get their Bitcoins not through mining, but they get it through an exchange. And what happened is that the regulators just took that as an entry point for regulation, especially also the KYC, AML regulation that you then go at the exchanges. So I think there's always some kind of a possibility to find an entry here. And that reminds me a little bit of the early history of the internet. I don't know those who are old enough to remember the 90s, when you had the fight between Yahoo and France. And France wanted to basically forbid Yahoo to sell certain products. And Yahoo first said, the CEO very remarkably, they have no chance. They cannot regulate us. This is the internet, this is the new world. But France very quickly found something to regulate or to confiscate. And I think that's always, there is always a physical or a person or an exchange or a computer that you can basically attach. So that I don't think there is a situation where countries will really run out of possibilities to regulate something, especially if something becomes big and popular.
Thanks for that. So maybe I have another question that is related to the current situation of COVID-19. So what do you think? What is the effect, or if there is an effect of COVID-19 on the future of stablecoins? Martin, what do you think about that?
Well, difficult to say whether it has an implication on stablecoins, and I would say it probably increases the need for an unpegged stable, reliable financial mean of exchange, because people are simply getting more and more worried about inflation. But here, then I think it really depends what kind of stable coin we are talking about, right? So it's probably not like an USDC or an USDT that we have today. But I think this inflation fear might be a catalyst for projects like a Libra or similar. I think this inflation fear is something that we really see with our customer base any day today. And I think we also see that they clearly emerged since the last 5-6 months. And I think out of this, someone will probably try to jump into this opportunity and come up with something that offers stable with whatever reference currency, however, a more stable digital stable coin.
All right, thanks. So we are almost at the end. So I would like to ask you to give us a final sentence. So what is the key takeaway you want for the audience to take away from this discussion about stablecoins from your perspective? So maybe Thomas, you want to start?
Yeah, I think the key takeaway and what is important is to remember that privately issued money is not something new. What's new now with stablecoin is really the technology. It's a different technology. There are different players than in the past. In the past, the privately issued money came from commercial banks. They were regulated entities. And now we have new players, new technology. And to some extent, if history doesn't repeat, then it rhymes, as Mark Twain said. So we are seeing some of the same things that we have seen in the 19th century.
Thanks. Alex?
Well, my sentence would be simpler. I would say, watch carefully, but let it grow. That's my view on that.
Thanks for that. Martin?
Use the innovative stable coins that we already have to build new innovative financial products.
Great. And I'm not sure whether Eli is still here. We might have lost him during the panel. Or Eli, are you still here? Unfortunately not, but I would like to thank you very much at this point for sharing your insights and expertise with us. It was very interesting, and I think also very worthwhile for the audience to hear all these interesting news and perspective on these important topics.
Thank you very much, everyone. See you.
Thank you. So I would like to hand over to Moritz for the second panel then, the Crypto Value Association panel. I'm already...
Yes, great job, guys. Big thank you again to the panel participants and also to you, Florian, for these questions. Let's come to the last session of the day. It actually originated from a collaboration with the Crypto Value Association. And the next panel then is led by Amy. Amy, yeah, I will leave the stage to you now and to your guests.
Hi, everyone, and thank you, Moritz, so much. And also thank you for the token engineering team for putting this event together. We have been learning so much throughout the past hours. And it's my utmost pleasure to welcome our panelists as of the next panel's guests. Who are important players of the field when it comes to stablecoins and how our field is going to evolve. So besides Gustav, we have Ilya from uHodler and Jerome from Ledger. I invite you all to unmute yourself and maybe just introduce yourself, which company you represent, what the company does, and how the company is involved in the topic of stable coins.
Yeah. Hello, everyone. Hi, Amy. Thank you for the introduction. It's very nice to see such a big audience at this late evening. That's just one more indicator that we work at the highly dynamic industry. So that's great. So my name is Ilya Volkov. I'm CEO and co-founder of uHodler, crypto-backed lending platform. As for stablecoins, we have all major stablecoins integrated to the platform, and we use them for different reasons, different use cases. First of all, of course, for payments. So.
Thank you. Jerome, you want to go next?
Sure, or Gustav. Gustav, you want to go next, or should I go?
I can go. Thanks, Jerome. Yeah, so also I did a small presentation earlier, but if any of you guys tuned in afterwards, I work for the Maker Foundation, which is the project behind, the company behind the project MakerDAO. We issue the decentralized stablecoin called DAI. It's the biggest decentralized coin and by far the most significant one. We're also the third largest stablecoin in general by market cap.
Amazing, and you get a very nice background.
Thank you.
So my name is Jerome. I work for Ledger, where I foster the client success in both the B2B side, Ledger Vault for institutions, and the B2C side, the two flavors of Ledger Nano X and S. So I particularly care about onboarding, support services, adoption, advocacy, and retention. And I try to be the voice of our clients inside Ledger, and also a technical point of contact for some topic that I know about, notably Ethereum and things related to blockchain architecture. And on the side, I'm the president of a nonprofit called Ethereum Friends that runs the eponymous website and run a conference in March every year in Paris called HCC, where I had the pleasure to have lots of people from the token engineering group and from Switzerland as well. So very happy to have you back in Paris next year, hopefully.
Cheers to that. Thank you so much for to all three of you. The first question is going to be addressed to Gustav and to Jerome. And if you could elaborate a bit on the two main groups of stable coins. So we have learned earlier that there are two, when it comes to design, we can break the stable coins down to the ones which are pegged by fiat, and then the decentralized ones, basically the algorithmic ones. So my question is, which are the main benefits of each? And also, Gustav, when we talked, then you said that everyone thinks that DAI is an algorithmic one, and then you corrected me that no, this is not the case. So if you could address this point.
Sure, maybe I'll start first. And yeah, so I mean, when you talk about decentralized stablecoins, right, you have the ones which are pegged like DAI. So basically, DAI is backed by on-chain collateral. So people would post collateral in smart contracts in our system, and then based on the value of the collateral, you can then draw DAI against it. DAI then maintains a peg through market mechanisms, so through people being able to arbitrage around the peg. So DAI is like more pegged by the market forces, you could say. And then you have like the algorithmic stablecoins where we currently see stuff like such as Ampleforth and Terra. We also saw previously a white paper called Basis, where these stablecoins, they actually work without having collateral, but they work by incentivizing or like issuing new stablecoins basically depending on supply and demand. So there you have like essentially like an unbacked stablecoin that is the peg is maintained by an algorithm, and then you have a stablecoin like DAI where the peg is maintained by market forces around the peg. And then the third group, so you have like algorithmic, then like on-chain collateralized, and then the third group is the centralized ones. Jerome, if you want to take that one.
Yeah, well, I would say that the benefits of the different types are more. It's more a question to ask to the person using them. Like I personally trust DAI a lot. I think DAI is very sound money because I believe in Ether as a cryptocurrency, so I believe in Ether as a collateral. So I'm happy to put some Ether in a maker smart contract and withdraw DAI against it. But some people are more accustomed to a particular currency. So let's say that you believe that the people behind the USDT are indeed storing the currency that they have in their book and thus printing the USDT accordingly. Then you can say, well, I'm happy with USDT because I see that it's a currency that is backed, a token that is backed by real money, let's say, or fiat currency, let's say. And overall, like you've described a good use case for cryptocurrency that are stable coins. You can do arbitrage, you can benefit from a couple of financial primitives on top of it. But moreover, I think one of the key benefits, at least from a French tax-paying citizen, is that when you switch your Ether or wrap Bitcoin to a stable coin, it's not really considered a cryptocurrency in France, so you don't really have to pay tax yet on it. So it's a good way to let's say crystallize your gains if you have some in cryptocurrencies. And that's one of the key benefit, I think, right now.
Yeah, I think also just to add here, so like USDC has also maintained like a pretty good integration level into like dApps in general. But historically, we have seen DAI is having way more activity in like the dApp and decentralized finance space. So like DAI, like sometimes you would sacrifice a little bit the stability and liquidity to gain like an improved access, where with the centralized stable coins, they're like often less used. Like Tether, for example, is starting to be used more and more, but it's still like on a much lower level than DAI, and also at a lower level than USDC, but it has better liquidity. So you would often see like the centralized stable coins having much higher trading volumes on centralized exchanges, where like DAI, for example, has really, really high trading volumes in the DeFi space and in the DEX space, decentralized exchange space, for example.
Oh, and also we should mention that different stable coins have most of them are ERC20, but there are many flavors of ERC20. Some people like to add some checks like I want to make sure that I can blacklist or I can whitelist people, or I have multiple checks in my smart contract, or I do integrated thing here and there. And thus, some smart contracts are a little bit more optimized. Some smart contracts are really straightforward, like doing a transfer from Jerome to Amy can be more efficient, computationally wise than in DAI than in other crypto. So I don't want to be a super big DAI proponent here, but I have to say that DAI is usually very straightforward and you don't consume that much gas on Ethereum when you do a transaction in DAI, and thus you kind of save a little bit on the transfer at those very high gas price right now.
I thought you wanted to say that it's important to mention that DAI reached 1 billion logged in DeFi in July. I thought that's what you wanted to add, but this is true. This happened in July, right, Gustav? So kudos on that, and would love to hear a bit more about you, Hodler. So Ilya, you have many stablecoins integrated, and which are the use cases you see among your community? How do the users of you, Hodler, use the stablecoins?
Yeah, sure. So we have all major stablecoins integrated to the platform. Let me share my screen very quick to show you a couple of slides. Let me know if you can see my screen.
Yeah.
Yes, we do.
Yeah, we can.
Yeah, perfect. So here you can see the list of stablecoins integrated to our platform, and here you can see the popularity of different stablecoins on uHodler. As you can see here, we've got some splash in demand for Paxos and TUSD back in May and June this year, but it looks like Monster Tether USDT got its positions back nowadays. But I think more important and more interesting that we see here stable and continuous growth on demand for digital gold, for Paxos Gold, on top of this yellow color. So I think the reason here is quite obvious. And back to the previous panel, and back to implications of COVID-19 and global pandemic and global scare of hyperinflation, here is the answer. Like, people are trying to discover more options to make their money work. And gold and digital gold and stable coins like Paxos Gold offers some nice opportunities. By the way, we also have here DAI, and share is not so big yet, but we can see here some step-by-step growth. I think we could get even more share for DAI if it could be a bit more stable against other stable coins. But I think it's something to discuss with Gustav offline.
And how would you explain the jump in USDT between June and July?
Look, if you see January, from January to April, it was almost the same share for USDT. In May and June, it was some splash in Paxos and TUSD. Mm-hmm. As for Paxos, I can explain because I have noticed a lot of promo campaigns from Paxos and a lot of partnerships. Like, they partnered with Binance, or they partnered with a lot of other market participants, and I think it just a result of very active market position. As for TUSD, actually, I have no answer. So it was just a splash, and now it just stabilized. So speaking about use cases, as I mentioned, we have two main use cases on the platform. So first is just the payments. Users can simply use stable coins to fill their accounts, to receive loans, or to pay their loans. And second is savings or interest accounts. So users can simply benefit from interest getting on their stable coins deposited to the platform. And here I'd like to give you one example from traditional world. Don't be scared, I have just a couple of slides. So many of you know the credit trade strategy, right? It came from traditional finance. In this example, we see the case where investor can take a cheap currency like Japanese yen at a low interest rate, like for example 0.1%, then convert this Japanese yen to Mexican pesos or buy Mexican bonds, and benefit from 6.5%, right? So it's a very old traditional strategy, and I think now the strategy works well with crypto, with stable coins. Like, for example, user can take his or her cheap fiat, or even borrow cheap fiat from traditional bank, as low as 1% borrowing rate, convert to stable coin, and use the stable coin in many different ways. For example, a user can lend these stable coins to exchanges. Many of exchanges, offer some nice depositing rates for stable coins in order to fund their operations, in order to fund trading operations, margin trading operations. So, and users can benefit from, I would say, from 5 to 12% annual on their stable coins. It's just a crypto carry trade. It's just the same strategy that came from traditional world to the crypto industry. So it's just one of the possible use cases. But again, the major use case is still payments. We have main fiat currencies, main global, I would say, fiat currencies integrated to the platform with the major traditional payment systems like bank wires, both SEPA and SWIFT for global payments. We have different credit card payments payment providers integrated, and actually stable coins are just some kind of substitute to traditional payments. It's just a major use case.
Interesting. Thanks so much, Ilya, on the detailed response. The next question is to Jerome. So, Jerome, how does Ledger stay on the top of stablecoins integration, because there are so many stablecoins and Ledger Live has it all. So that is one question. And then with the rise of DeFi and with your hat of the Ethereum France, if you can share how you see stablecoins developing.
Sure. So it's indeed a permanent task for us to keep up with all the innovation that's happening everywhere. So a stablecoin, when it's just an ERC20, it's pretty straightforward. Like we say, like, okay, it's an ERC20, so we have all the like an exchange. Basically, we have processes to integrate new ERC20, so it's easy for us to list it. And then it switched to DeFi, and now people want to do lots of things around DeFi, like for example, like governance and DeFi. If you have a Uniswap token or Sushi Swap token or Pickle Finance token, you can vote on governance thing. So we need to support a new way of signing with your ledger without necessarily sending a transaction, just for you to participate in the governance poll, for example. So we got flagged on Twitter that it's super difficult to do that with a ledger, and we are very. I personally feel very proud that lots of DeFi players are using our product to secure their keys, but we need to keep up with the use cases that they want to use it for. So those new way of signing is, for example, something that we have in our future releases. So we try to keep up all the time with what can be done with our product, and we try to integrate more and more natively with those new applications. So the typical user of Ledger will do a send and receive and swapping and buying crypto and having basic use cases for Ledger Live, but more advanced users are using DeFi. So how will we bridge those two? It's typical that a DeFi product will integrate Ledger directly, so you can connect your Ledger and start playing around. But we need to also allow the more casual user to interact with it. So we are trying to find new way to actually support that directly in Ledger Live, and hopefully in the coming weeks you'll see interesting news about that. But on the side, we are also doing lots of B2B work with Ledger Vault, and in that we do exactly the same. Like we integrate easily those ERC20 when it's come to the stable coins, and we start to see from our institutional clients great interest to start playing around with DeFi products. So we are following up on that as well, and it turns out that other blockchains are also trying to catch up on the stablecoin use case. So I mean, like the Tezos Foundation through the consulting firm Nomadic Lab announced something with Société Générale working with Banque de France on something involving stablecoins. So it turns out that now we need to follow up also on supporting tokens that are built on Tezos, for example. So we are well connected because we've sold a lot of devices, and we have lots of clients in the B2B side, but we are constantly trying to prioritize what will be the next big thing and how we can support it and actually interact with that.
Thank you. And as of the president of Ethereum France, how do you see
I'm of course completely biased positively on Ethereum, and I mean it's mind-blowing to see everything that's happening on the DeFi side. I mean automated market making, providing liquidity on decentralized exchange, but moreover applications like I said Pickle Finance, for example, that lets you do arbitrage directly between the different stablecoins. Curve Finance, Yearn, those projects are for a lot of them lightly audited, very risky, but offering arbitrage strategy and way to get yield on your stablecoins directly on the protocol. And that's I'm always amazed by the intensity of the innovation on the Ethereum blockchain.
Thank you very much. the next question is going to be addressed to Gustav. And Gustav, in our prep call, we talked about how biased traditional finance can be, and how DeFi and DAI is providing equal access to everyone, and basically takes away the point of centralized failure. So it's built on no centralized failure. And basically the question is that which are the challenges you encounter when you're helping in different geographic locations, or these projects unfolding and using DAI?
Yeah, so I think if we just take it from you know, kind of like the difficulty of like issuing DAI, right? I mean, there's like a lot of work that goes into it, and you know, like doing a decentralized stablecoin, so having like a decentralized stable value that is not secured by any centralized entity is also something which is quite difficult to maintain. So like the Moderator protocol, you know, the community manages all the monetary and fiscal policies, you know, the collateral types, the risk assessment of each collateral type, and so. And the reason why you kind of like go through all of these hoops to get a product like DAI in the end is because that you know, so first off, we're kind of like in a situation where like a lot of the people that we want to be targeting is people who live in, you know, countries where like the development of their local financial systems, you know, simply aren't on par. So we want everyone in the world to have equal and fair access to, you know, an alternative financial system. This also quite a lot ties into you know, kind of like some of the values that we're working on from like a mission statement, which is really that, you know, the traditional financial system, you know, underserves a lot of people, and this is done both through mismanagement but also through like an inherent bias that it has. So you know, like the traditional financial system is often biased against things such as, you know, race, origin, religion, and current locations. You know, like depending on where you're born, basically you will have vastly different access to financial services. You will simply like, just in terms of finance, there's a lot of other things that are like biased against you depending on where you're born. But just in terms of finance, we actually right now in a position where we potentially can solve or like give people access to a fair and equal alternative, right? So I think like some of the stuff that you know, really comes up from like all that work of creating something which is like unbiased also ties into the fact that, you know, we mean that if people, for example, in Argentina or Africa, they start using DAI, we don't think that they should, you know, have like the counterparty risk of like a jurisdiction like the US, for example. So, you know, if you use, you know, a centralized stablecoin, you'll automatically inherit like the risk of, you know, something happening in the jurisdiction where the stablecoin is being issued. So like right now, a lot of the people who's using the centralized stablecoins, they will automatically, you know, bear the risk of like the American, you know, jurisdiction, right? The US regulatory environment. And this is something that we want to abstract from the end user. So that's really why we try to create this system where there's all of these like checks and balances in place to ensure, you know, like a fair and equal way of accessing, you know, stability and financial services, no matter where you are.
Wonderful. This is so exciting and so inspiring. So I did not plan to do this, but Thomas Moser asked the question, and as talking about centralized stablecoins, and I actually believe that all the central bank digital currencies started to pick up more and more because Libra, as in Facebook, came out with their Libra project. So this is to each of you in just 2-3 sentences, if you can say, what's your take on Libra? Jerome, you want to start?
Just picking it up as the central bank digital currency use case, it's something that was likely mentioned in this panel, and that's a type of it's probably a type of stablecoin of its own, a stablecoin that is likely to only interact within the limit of the network that are accepted, but it's definitely bringing a very good use case for less assets that are not yet completely full-fledged, that don't have completely full-fledged support in the financial system right now. So the whole use case that we had we were talking about back in 2018, mainly security tokens, and that's only now taking off a little bit. This use case definitely need a CBDC, a central bank digital currency, to really take off. And the existence of this kind of project, like every major central bank have done something towards that. Doing delivery versus payment instantaneously is definitely something that is very appealing. And Libra itself gave them some sort of a wake-up call that they need to progress, and they need to progress fast, because at some point an actor that has already a huge network effect can come up with a similar thing and basically disrupt everything. Because for now it was just nice people in Denmark, or nice people in Russia, or nice people in small developers everywhere in the world that were building small thing on blockchain, and now you have a major actor that just come up out of the wood and say like, hey, I'm going to do this as well. And suddenly they match all the cases. Like they have a trustable reputation, they have the ability to deliver, and they can do as good as the central digital currency, and in the meantime with their token also deal with the payment use case. Like having money that is transferred easily everywhere, and also they kind of have a marketplace already on Facebook. So that's very scary, I think, for states, and they are reacting fast. So my take on Libra is that it will definitely accelerate the path of blockchain adoption as a whole.
Yeah, I think.
Oh yeah. Gustav, go if you.
Yeah, so I think like Libra, like, so I know that they have made some amendments to their design, because I think they submitted an application to FINMA. So I know that they've started to make like some change to the design. So like depending on like what actually comes out of it, I think we will see like, you know, like the actual like depth of it. But I also believe that, you know, as we're also seeing now, there's a lot of like cross-chain functionality being built up, you know, around Ethereum, because right now there's so many assets and so much liquidity on Ethereum. I don't think the assets or the liquidity on Ethereum will change. You know, I think Ethereum will continue to grow, but I think we'll also see like compatibility being built between the two chains. And like if that happens, then, you know, like everyone using Libra will be very, very easily onboarded into something like DAI, for example. So you know, like right now you will have a much more mature ecosystem around DAI than you will have around Libra in the beginning, and that's just like because of like so many projects, so many. I mean, no matter how big of a team they have and the resources they have, they would never be able to, you know, expand to like a state where they would have like the equal services on Libra. So I think it would be like a pretty, you know, easy onboarding tool to get people from Libra into DAI, into Ethereum, for example. If, you know, they choose to go with like a setup that will allow this. And if they choose to go with a setup that wouldn't allow this, then I think it would also kind of like limit their ability in general, because I don't think like it will be like quite as good as an experience for like the developers building there necessarily. So I think like historically we haven't really seen any like permissioned or like, you know, privatized blockchains that has really taken off, and that's just because it's so difficult to get like developer activity on something that isn't open. So in general, like a lot of the devs working on these things, they're like very, very part of the open source community, right? So I think, you know, if they do it the way that I hope they will, which will be like the good way to do it, I think, then I think it will be like a great way to also get new users into Ethereum. And you know, even if Libra ends up being like a massive platform for payments, I still see Ethereum moving very much forward with kind of like the trend that we have seen over the past 6 months, with like tons of innovation, you know, tons of growth, a lot of new assets coming in. So I think like Libra will be positive for the space, and potentially could be like a good place to like source your next millions of users.
Yeah, so I'm also not a big fan, or not a fan at all of Libra. A year ago, or even more than a year ago, when I first time heard about Libra, I thought that they will need to transform their model. They will need to find some better concept, and finally they had to transform. And as of now, I think they still don't have a working concept. So they still need to find some working concept. So I don't like Libra in terms of the product, or even concept of the product, but I like their investments. I like their investments to the industry. So almost the same like Jerome and like Gustav said. So they are contributing to the market. They're contributing to the community, to professional community. They're pushing some good investments to the market, and as a result, I think we will get something. At least we will get more talented engineers on the market. That's great. But again, as for Libra by itself, I'm not sure.
Thank you very much. I like that Gustav touched based on already. I think you talked about adoption a bit. That so Libra potentially could drive adoption, and what other use cases are going to drive adoption? Maybe Jerome and Gustav, if you could talk about it, and to be mindful of the time. Then I will ask the last question to everyone, and then we'll hand it over.
So I don't know which use case will drive adoption. I think more inflation will drive adoption probably.
Adoption of stable coins.
Oh yeah, well
Yeah.
Yeah, okay. So why not have the
more printing?
More printing will drive adoption for sure. Like the use case that was mentioned by Ilya is that if it's really cheap to borrow money at your local bank and you can use it on anything you want, why not buy stablecoin and put them on a compound interest generating app on Ethereum or another blockchain? I think that's fun. That's a fine use case as long as you are willing to take the risk of the smart contract and the blockchain underlying the hosting. But I wouldn't be I wouldn't know which use case exactly would drive more adoption actually. So leaving my panelists for
So I think like in terms of like use case, I think like we have definitely seen like finance being like a bigger one now, right? And I think what the use case necessarily is pushed by is like the immense increase in innovation, right? And also like the user experience. So I think like over time, as we see those two things like scale up drastically, then I think that will really help with like the adoption of it, right? So to take like an example, we have a Sabrify. I'll write it in the chat as well if you guys want to check it out. But basically Sabrify, they were like a relatively newly launched front end, like DeFi front end, like an aggregator of all the different protocols. And I saw that they put out like a tweet earlier, like a month ago, or like a month and a half ago, that they had almost 350,000 individual users. And I think for us to look like a year back and think that like a front end to interact with these services that isn't like the native front end, for one of those to have like 350,000 users, I think is like a lot of adoption in like a relatively short time span, right? Also, if you go in and you look at like comparing, for example, like DeFi and like stablecoin users on Ethereum to like similar fintech markets such as like neobanks, as well as like the early peer-to-peer lending, the growth rates we are seeing in like the DeFi, stablecoin, and Ethereum space is simply much higher. So I think already now we are kind of like driven by some of the use cases that we already see around us now. So I think like having that combined with like the increased innovation and user experience improvements that happens over time, together with the maturity of the protocols, because as Jerome also mentioned earlier, we see a lot of these new protocols coming out, but a lot of them has been out for like less than a year. So we also kind of like have to take that like Maker is like the current version of Maker is not even a year old. So like if we look at the numbers, like the growth we see with like within such a short time period, when these protocols become like truly mature, which will also make them more suitable for like retail use, I think that is really what's gonna drive adoption. So I think like the use cases is already the stuff that we are seeing around us now, and then hopefully when Ethereum 2.0, that will trickle down to like payments, like for like more like on like the low end of like retail users to also be able to use it for stuff in their everyday lives.
I have something to add very quick. I think there is one more very simple use case that could push adoption. We still have some huge disproportion. Like 80% of market cap is still locked in dollar backed or connected to dollar stable coins, right? So at the same time, we have really huge demand on stable coins connected or backed by euro, by GBP, by CHF. So probably CBDCs will help us to solve this issue, probably some private issuers, but definitely I think that more traditional currencies connected to stable coins will push the adoption.
Yeah, you mentioned CHF as well, shout out. So my co-organizers are telling me here that our Wednesday night live is going to run a bit later, so we are a bit late. I hope you don't mind. This is due to the exciting discussion we have here. And maybe a last question to conclude to all of these much respected panelists. So what you're most excited about when it comes to stable coins? So what really like makes your blood boil, or as in you're very passionate about?
So I'm looking at NFT staking right now, having fun.
I know what Jerome is excited. It's wine on the blockchain, staked as an NFT.
Exactly.
Okay.
Okay, I have a bad joke. So it's old and bad joke about Alzheimer disease. So Alzheimer advantage, new friends every day. So the same with the crypto market. If you work with crypto, if you work on crypto market, you get something new every day. You have something new, very challenging, very exciting every day. So it's about crypto in general, it's about blockchain in general, and it's about stable coins as well. So the most exciting thing is that a future starts now. So we have a lot of discussions, we have a lot of ideas, we have a lot of nice projects, and that is something that boils the blood. So we are building the future.
Exactly. That's a good way to conclude. I think we're building the future.
Yeah, I'm very excited for real world assets interacting in DeFi protocols.
And how about, because I remember when we did the prep call, you were mentioning the adoption in Argentina, because you touched on the biggest adoption of DAI, or the biggest usage is in third world countries. Gustav, that was a follow-up to you. Oh no, you are muted. Wait, I try to unmute you.
So I'll answer for Gustav.
Yes. Let's do that. He's yes, the messenger.
Yes, indeed. It's the usage of DAI is very common in third world countries, and especially where you have lots of inflation. And I guess lots of people at Maker are you have use cases from people that are working with Maker in Argentina. Do you, Gustav?
Yeah, sorry, my Zoom froze, so like I couldn't unmute myself. Yeah, so I mean, I think that is like something that we're very, very excited about as well, right? We have like platforms in like third world countries where we go in and make like a difference for people every day. Like one platform in Argentina, we have like 70,000 people that only trade in DAI on a weekly basis. So I think projects like that makes us like very, very hopeful for like where the DAI demand will come from in the future as well. I still think before we can really go in and really make it like a really, really big thing, we need to have more scalability, right? Because I think that's also mentioned earlier in the panel, or in the previous presentations and the questions earlier tonight, so like right now Ethereum is pretty expensive. So that of course like limits the ability. So like over like the next 6 to 12 months, layer 2 solutions will make it a lot cheaper. Hopefully Ethereum 2.0 will also be coming out. And that's when we can really start targeting these things. We've also been doing a lot of effort in getting liquidity into these countries. So we start working with local partners, usually like an exchange, or like a fiat gateway, or like some OTCs, and we start building up liquidity in the country. Because if you take it from like the initial standpoint, most countries have some BTC liquidity, but even that some places is pretty scarce. So if you start from that standpoint, you still need to get DAI into the country. So that is something that I'm very excited on working on over the next 12 months.
Fantastic. Thank you so much. I'm putting my hands together to Ilya, Jerome, and Gustav, and handing it back to Moritz.
Yeah, thanks a lot to you, Amy, and your three guests. Great insights that we got over the last half an hour. Before we conclude this event now, I would like to hand over the word to Markus for a short summary. He's not only a team member and helped us to set up this event, but also senior researcher and lecturer at the Chair of Computational Science at ETH Zurich. Yeah, Markus, please, could you give us what's your take of this event today?
Yeah, thanks, Moritz. Well, first of all, thanks to everyone involved tonight. That was a very intense and great lineup and program. And judging from the sophisticated questions in the comments and the panels, I'm probably one of the dumbest people in the call tonight. So nevertheless, let me try to. I made a small list what I learned from the individual talks, and I have to read it because it's just too much information. So from Aleksander, I learned that actually nothing is stable. Bitcoin, fiat, stable coins, it's just for different reasons. They are not really stable in the long run. I also learned Bitcoin has no intrinsic value, and that's a good thing. Fiat also has no intrinsic value. We're not so sure if it's a good thing there as well, but overall for welfare and from point of view of economics, it's a good thing. From Gustav and DAI, I learned while a central bank controls the money supply, maker and competing protocols probably is an automated market maker between supply and demand of money, which is a very different way of looking at what money is and how it should work. Also, although DAI is soft pegged to the US dollar, it has, quote, no formal relationships with the dollar, which I think is interesting, isn't it? From Stefan, from RAI, I learned you can provide stability to the DeFi ecosystem also without being a stablecoin. So we see a lot of different approaches, which is great for, for innovation. From Robert of Liquity, I learned that it can be really hard and complicated if you don't have a finance background, and you actually lost me. I'm really sorry for that, but I will check back in Q1 when you guys go live. So please forgive me. From Armin, from the Swiss franc stablecoin and Bitcoin Swiss sister, I learned that after all, DeFi will probably not protect me from negative interest rates, which I hoped it would. Stablecoins are still good, but you need to create value somewhere else, was his statement, which I really want to stress as well. And I think it's important. We are at the end, at the moment, we talked about money, different forms, very innovative forms, but it's money still, and value creation is not in the money itself, it's somewhere else. And this leads nicely to Akseli's quite like meta view presentation, which I thought was great. He started with the question, what is stability actually, and based on what do we measure it? And one of the statements he made was, money is not a thing, but a social medium. And in case of fiat, unfortunately, it's actually based on power, and he mentioned violence and coercion at the end, because nation states have armies. And crypto, according to his view, is opening this design space for economics and for monetary policies and the way money is designed. And quote, start shorting the existing system, which I think is close to my research actually. But he also said, in that sense, DeFi as of today is still conservative in what it does. Despite all the interesting and new technical and also from the point of view of mechanisms we've seen tonight, the design space is much, much bigger. And from the panels, I can only give a few summary remarks because at the end, it was just a lot of material to process. So remember, private money is not new, but today the technology is quite different and the players are different. So that should still make for an interesting new dynamics in the game. And still let innovation flourish in that space was, I would say, the understanding, the common understanding of the first panel, despite players like Facebook who kind of ruined it a bit for DeFi in a very early stage and draw the regulatory attention to everybody. So at the end, all of this leaves me torn between opportunity and threat. So the opportunity is with stablecoins, I can save my cash today instead of keeping it on the bank account. At the same time, I'm not sure, and we touched this only a little bit, the potential danger that DeFi, as it's hyping currently, is in a way recreating what's already there in the financial markets today, like the layers of derivatives and stuff built on stuff, and the complexity is exploding. So that we are careful that it's actually not falling apart at the end. And the final statement was that designing stable coins is maybe not the most difficult part, but getting adoption, acceptance, and over time stability is. So there's hope when we look at places like Argentina in terms of adoption, but of course, the transformation that people are going through there is hard, and let's not make it too hard for all of us in the next months and years. So thanks everyone for this great evening.
Thanks, Markus. Great summary at this point. I think you hit the nail on the head. Well done. Yeah, so how to conclude such a great event? In my opinion, actually fun would be the perfect antidote to such an information input that we experienced over the last three and a half or almost 4 hours now. Usually we would like to invite you for a couple of drinks afterwards. Unfortunately, during these times, it's hardly possible, as you can imagine. So yeah, there is not much to say, but a big thank you from the whole team around Emi, Markus, Jonathan, and Florian, to all the participants and the speakers. Yeah, that was the third event of Token Engineering Switzerland. I would say stay tuned for the next one, and goodbye.